This environment was clear from early 2022 that we could be back in a 4, 5, 6% interest rate environment.
Rates are a very self-correcting sort of thing.
What we need stability. Rates don't need to go down from here. What we're seeing is the underlying fundamentals are still good.
Businesses are looking at the fact that the cost of capital is rising and they're starting to pull back on investments.
The higher for longer is coming to a reality where the market's been in denial of that.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
What a move in this bond market. Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio. Alongside Tom Keene and Lisa Abramowicz, I'm Jonathan Ferro. Your equity market trying to stage a recovery, just about positive on the S&P 500. The moves overnight in the Asian trading session, briefly 5% on a 30-year yield and very, very close, TK, to 4.90 on a 10-year.
The mathematics here is really important, and we don't do math this early in the morning, but really, John, on a pro basis, is from a careful analysis of convexity to looking on a vector down free fall. Something changed yesterday, and the mathematics went out the window. This is a morning of price analysis of fixed income, and not to be inflammatory, but it borders on free fall.
Oh, price has been absolutely hammered, that's for sure, particularly over the last couple of months. Lisa, looking at this move right now, currently yields high by 2 basis points, 481.46 on a 10-year maturity. Overnight, Bramo, 487.99 on a 10-year.
What's the circuit breaker? It's not coming from Washington, D.C., that's for sure, because this doesn't seem like there's going to be any resolution there without leadership. It's not going to necessarily come from the data being weaker than expected, with job openings coming out stronger than expected, and the manufacturing numbers also better than good, to quote Tom. So at what point do you get a circuit breaker from something other than just people who start to buy?
This reminds of Boltanski over at BTIG on a speakerless house. This is what he had to say. Over the long term, ousting the speaker in this manner is wholly consistent with broader structural concerns regarding American political dysfunction and the country's debt trajectory. TK, those two stories are not separate. They are combined this morning.
I watched it in real time, trying to explain this to cherubs at the dining room table last night. I thought that Mariana Sotomayor in the Washington Post captured it brilliantly. And John, this goes back to my grandmother on the couch, who knew Union soldiers in the Civil War. And she was inflamed by the phrase Civil War. She said, Tom, it was the War of the Rebellion. And the Washington Post this morning led with that historic word for Washington, rebellion.
AMH coming up a little bit later. Back-to-back double-digit moves on a 10-year yield coming into Wednesday. Check out the equity market on the S&P 500. Closing yesterday at the lows we have not seen since early June. This morning, just about positive by 0.02%. We need to talk about the financials later. We'll do that this hour. The charts of Citi and Bank of America over the last few months are not pretty at all. Yields up a single basis point, 481 on a 10-year. The dollar showing some weakness after really dominating G10 over the last couple of days. Euro dollar here, Lisa, 104.96.
What an interesting time. And the economic data just keeps coming in stronger than people expect, which is part of the reason why. Again, what is going to stop this? It's terrible. Okay, no, it's not. But at the same time, it raises this question about inflation. Today, we get 8:15 a.m. U.S. ADP jobs report. People discount it, although maybe not if it comes out, especially with an upside surprise. And 10 a.m. we get ISM services data as well as factory orders and durable goods. Yesterday, this is what turbocharged the move. Job openings surprisingly increased, not decreased as expected. That perhaps gave another leg higher to some of the yield move. Today, the OPEC Plus coalition due to hold a meeting of the Joint Ministerial Monitoring Committee. Basically, are they going to keep cutting their production? Are they going to keep the cuts in place, or are they going to increase it at a time where crude is still one of the things pressuring inflation, pressuring some of the yields? Although it seems to be that the OPEC Plus members like this. And Fed Speak today includes Fed Governor Michelle Bowman at 10:25 a.m., Chicago Fed President Austin Goolsbee at 10:30 a.m., as well as later in the afternoon. Do they start pushing back on the yield move at the pace?
Most interesting thing yesterday in the blur of an historic day was Secretary Yellen beginning to talk up monetary policy. In proxy for Powell, I don't know. But Goolsbee, the debate student out of Milton Academy in Boston, can take a more behavioral construct here. And to me, it's just real simple. We're all going in search of the Powell put. When is the chairman going to go, okay, we've been doing this, and it was good to see John and wave at Lisa at Jackson Hole, but, and there's going to be a change.
Well, the but right now, Tom, is the economic data. Monday, ISM manufacturing. less worse than anticipated, better than expected. Yesterday, job openings absolutely exploding higher. And the real risk coming into Q4 wasn't that we just get this test. There was two-way risk. It cuts both ways. It wasn't just about the consumer test coming into Q4. It was also about the risk that we re-accelerate in the economy going into 2024. That idea was pushed by Andrew Hollenhorst of Citi and also Neil Dutter of Renaissance Macro. And the data we've seen over the last couple of days, Tom, if you plug that in, you raise the risk. I think you have that risk on the table they've got to grapple with, that risk can cut both ways. It's not just a slowdown, it's also a re-acceleration.
Hollenhorst with us later this morning. It's going to be fascinating. And John, all of this with a backdrop of a disinflationary vector. We are going to look to Washington today. I spoke to Anne Marie Horton after her exhausting day. She has, I believe, an interview today with a guy named Gates from Florida.
Congressman Gates, yeah.
He stood her up last time. You don't stand up.
I would say that this was a better time to do the interview. I think so. A little bit later, 5 p.m. Eastern time.
Tonight later. And we'll
balance of power.
We're going to focus on Washington and the history made yesterday, but right now on the history of this market in crisis, and when in bonds, it becomes about price and not yield. Margie Patel, honored to have her with us from Allspring Global Investments, Boston, this morning. Margie, you know, all the bow ties go out and they spout about yield, and there's a point when price matters. What do we do about a lower price in bonds, notes, and bills?
Well, I think we've had happen over the last year something we haven't seen, I think, ever, and that is that I expect the spread of treasuries over corporates and high-yield bonds is going to stay much narrower than we would think with the big increase that the Fed has made in short rates. And so I think that that's one of the things that's puzzling people. And really, when I look at treasuries and say, well, they're 4.5%, 5% with inflation at, say, 3 or 4%, that doesn't seem to be restrictive at all. And so I would expect that corporate bonds, high-yield bonds would stay in a narrow trading range.
Margie, I'm going to go back to 1998, and I'm sure at Lockover's there was a lunch of Felix Smith, Dan Fuss, and a younger Margie Patel. And what it was about is where, things begin to sweat. Do you have a sweat about our banking system? I'm not saying, do you own the banks? Do you want to own the banks? But are you worried about the financial integrity of our different capitalizations of banks?
No, I think the banking sector is in good shape because of the increases in quality and regulation. And also, they have not been going crazy making bad loans over the last few years. Corporations have extended their maturities. We haven't had a lot of big mergers and acquisitions. So I think the banks are okay, and I'm not looking for any kind of a financial crisis.
So, Margie, why is Citi, why is Bank of America trading below the lows of spring?
Well, I think it's because people are expecting that they aren't going to have the net interest margin that we had thought or hoped. And also the loan demand isn't really there. Banks don't want to make loans. They certainly don't want to make aggressive loans. So it's hard to see where the earnings growth will come from compared to other sectors.
So any reason to buy them going into earnings season, looking ahead to JP Morgan next Friday?
Well, the problem is that it's hard to see that they can have a breakout and on the upside have above average earnings. But on the downside, if rates continue to go up, loan demand is pretty muted. It's hard to see that they'd be very attractive either way.
On a relative value perspective, Margie, at what point do some of these higher Treasury yields challenge your thesis about stocks, challenge the valuation prospects that we've been looking at? Just because on a relative valuation, you're getting more in yields on 10-year Treasuries than you have in the earnings yield on the S&P 500 going back to 2002.
Well, I think that reflects the actually supply-demand. I think one of the reasons treasuries are so high compared to other parts of the bond market is simply there's such an enormous supply of treasuries. High-yield supply is down, investment-grade supply is down. So people who are looking for those securities are going to bid that spread narrower.
At the same time...
So I think no.
Okay, so you think no, but at the same time, there are a growing number of people, including Stephen Major over at HSBC, who disagree, who think that actually we are getting to a point where the relative value of full faith and credit in the U.S. government is actually getting much more attractive relative to the risk and the potential volatility in stocks, especially if you strip out the Magnificent Seven. Why do you push back? Why do you say that even if you're getting more yield in bonds, that's not necessarily going to shift you away from equities?
Well, number one, there's really no guarantee that Treasury rates have peaked and are about to go lower. There is a chance they could stay at this level or even go higher, again, because of this enormous supply. And when you look at the stock market and you exclude that handful of stocks that are trading at very high price-earnings ratios, there are lots of sectors of the market that are trading very, very reasonably and that actually have a cash flow yield competitive with short-term Treasuries.
Marky, there's so much confusion right now because there's so little conviction as to what is driving this bond market, particularly at the long end. I've said a few times over the last few months, asked 5 people, 5 different reasons. QT, rates are higher. Pick your poison right now. Look abroad. China. What is it? Is it the budget deficit in the United States? Is it the dysfunction in Washington, D.C. this morning and over the last week?
Well, we've seen a big increase in deficit financing from governments really around the world, and the U.S. is part of that trend. And it's only a couple of years ago that I think 15% of global bonds outstanding had negative yields. That's not an issue anymore. Yields have pretty much moved over to the positive side. So I think it just says that interest rates were abnormally low. Now they're maybe average. They could even go to be a little abnormally high. And that really doesn't affect the fundamentals of the stock market if we continue to have growth. And corporations are in very good shape. They are not over-levered. They're very cautious about capital expenditures.
Margie, I got it out, Margie. I've been up all night. Margie, I want to give some historical perspective here because you're too modest to talk about it. 1 year, 3 year, 5 year, you're solid 80th percentile plus. Your Sharpe ratio, which, folks, is all I look at of the 3 ratios, your Sharpe ratio is demonstrably superior to your peer group. And basically, you're a bond person who's been hugely skeptical in recent years about bonds. What do you say to people that bought the bond story and are looking at nominal returns wiped out for X number of years or inflation-adjusted returns wiped out for a decade? What should the people that have been clobbered in bonds do?
Well, I think they should examine why they accepted kind of outdated ideas about what determines bond prices and bond prices versus equity prices. And I think, again, the supply-demand factors come into play even on the bond side. We have an enormous flood of treasuries. There's no end in sight for that. So that makes the returns from other asset classes, whether it's high yield, investment grade, or stocks, look relatively more attractive because they don't have this huge amount of supply that's going to keep coming and hitting the market and needs to find buyers at higher prices.
Margie, thanks for the input
yields,
this morning. Margie Patel there of Allspring Global Investments. Do we need much high yields to find buyers from here? Gene Tenuzzo from Columbia Threadneedle later this hour, about 20 minutes away. Look out for that conversation. The moves yesterday did spark a policy response. Maybe. I say maybe because we're not sure. Dollar yen very briefly breached 150. This was the sequence of things, TK. Job openings in America come out much higher than anticipated. Yields up, dollar stronger. Dollar yen blows out through 150. And then all of a sudden, gap lower on that currency pair. The Japanese authorities refusing to confirm or deny whether they were intervening yesterday off the back of that, Tom. Keeping us guessing, but ultimately the chart speaks for itself. I suggest you all pull up that chart if you haven't seen it already. Dollar yen through 150 and then gapping lower all of a sudden.
Gapping lower, but what's important here on second intervention, I'm going to use that, I'm editorializing there, but on second intervention, John, they made a massive move from, say, a 149.80 down to 149.10. It was a bold move. This is a BS intervention, and, you know, we'll have to monitor it. They don't have an obligation to tell us.
A balance sheet intervention?
No, it's not a BS.
Something else.
It's something else. Yeah, and the answer is, you know, there's a whole history fraught here. Ken Rogoff and Rudy Dornbush have been brilliant on this, a guy like Ike and Green out at Berkeley. And the answer is, it doesn't work.
This is the issue.
Thank you.
Maybe it can do something about the pace, Lisa. Perhaps it can slow things down, change the trajectory, do something about the fundamentals.
It means that we're going to get to 149.99 again and again and again.
Chart.
I mean, that's essentially what we're going to do, is because that's the line in the sand. They reiterated that yesterday. Although maybe not. Maybe it's not intervention. Wink, wink. Nod, nod. Everyone's basically saying yeah.
Let's hear up, John. Bring that
Yeah, exactly.
I know.
On radio, this chart looks
149.10
perfect.
on dollar yen. Coming up next hour, Jay Pulowski of TPW Advisory from New York City. Good morning.
All eyes turn to the U.S. job market.
The jobs report, it beckons.
It looks like companies are just holding on to workers.
What you see is what you get. We're seeing a lot of strength.
This Friday, Tom, Jonathan, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
This is exactly what the Fed is looking for.
They now believe you can get back to 2% without damaging the labor market at all.
We might get a bigger whammy than we expected.
The September Jobs Report, Friday on Bloomberg Television and Radio.
On this vote, the yeas are 216. The nays are 210. The resolution is adopted. Without objection, the motion to reconsider is laid on the table. The office of Speaker of the House of the United States House of Representatives is hereby declared vacant.
Historic day in Washington as the House voted to vacate Kevin McCarthy as House Speaker. Welcome to New York City. Check out this market. Equities just about turning positive on the S&P 500 after a deep day of losses yesterday, taking us back to the lows of early June. This morning, positive by 0.04%. Overnight in the Asian trading session, some big moves in the bond market. Yields up by a single basis point at the moment, 4.81 on a US 10-year, on a 30-year, briefly through 5%. Up by a single basis point currently on a 30-year at about 4.93. Outside of that move in foreign exchange, the euro trying to make a comeback here and show some strength, facing the potential of a 12th week of euro weakness against dollar strength after 11 weeks of it closing out last week. 105.10, or rather 105.10, 105.10 on the euro against the dollar. That currency pair positive by 0.4%. And maybe the stress in the bond market starting to get people to think about the end of the cycle. Credit spreads wider, discretionary stocks struggling, bank stocks struggling, crude lower, 88, Tom. We're down about 1% on crude.
You can imagine if crude goes the other way. Of course, Edward Morris has made a real splash here on crude coming back. But really, other than the calming influence of crude, 97 down to Brent crude, just under 90, 89 at 92. I mean, I'm looking at the screen this morning, John, and you got to wonder what meetings are being quote unquote taken.
Between who?
In Washington, among institutions responsible for supervision and to an extent regulation, but also at these banks. I mean, what's the year-end plan? There's no year-end plan. There's an October plan, and you better get to it.
Add some extra spice to earnings season and those earning calls. They'll start next week with JP Morgan 2 Fridays away. We've said a few times on this programme, trying to frame what this bond market move really is. Is it a reflection of the extension of the cycle or a recipe to end it? I'd have to say, if you asked that question maybe a couple of months ago, it was the former. It starts to feel like over the last couple of days it might be the latter, just in terms of where this market is leaning. I'm looking at high yield spreads, not the level, but the way we've moved. I'm looking at discretionary stocks. Once again, great year, but struggling recently. And looking at bank stocks, Tom, to see the likes of Citi and Bank of America trading below where they were at the spring lows, post the tension of the financial sector earlier this year, Tom. That's quite something going into earnings season.
Yeah, the fancy bow tie word convexity means you're in control. Lisa, were we in control yesterday?
It depends who you mean as we. Maybe the bond vigilantes were.
So.
That's a good question.
I don't know. I think it's going to be sport. We're going to turn to Washington right now, and of course, with the leadership of Joe Matthew and Anne-Marie Horton, balance of power has become must-watch in Washington at 5 p.m. I look for that tonight. A gentleman from Florida by the name of Gates is scheduled to show up. This is really special, and we thank Invesco for letting us speak this morning to their head of U.S. government affairs, because yesterday afternoon, in that history-making moment, the bow-tied one got up at the House and said, "We will continue forward." His name is McHenry. He's from the Carolinas. He's a really interesting guy working in the trenches of political operation for George Bush the Younger and on through Carolina politics. Jennifer Flitton is with Invesco, head of U.S. government affairs, but has worked for Congressman McHenry over the number of years in chief of staff positions. Jennifer, thank you so much. Who is this guy? It was like Butch Cassidy last night. We know these faces, and to be honest, most of our audience, particularly our international audience, who is the Southerner, McHenry?
Yeah, well, he's the chairman of the Financial Services Committee, and he has been in Congress for almost 2 decades now. He is an institutionalist, and he is a policy wonk, and he's politically savvy. And it's not shocking that Speaker McCarthy chose him on that short list of members to succeed in time of emergency.
Mm-hmm. Jennifer, in the Washington Post this morning, Mariana Sotomayor, they lead with the word rebellion. That has a heritage, a tenor, a tone south of the Mason-Dixon line. Parse the distinction of Southern Republicans like French Hill of Little Rock or Mr. McHenry of the Carolinas. Parse their distinction from 8 or 9 people that have rebelled.
Yeah, these are fairly new members, right? I mean, you look at these 8, and these are members who mostly came in after 2018, and they really represent a different thinking within the Republican Party that was made very clear after the election of Donald Trump. And it really is a small number, right? I mean, the vast majority of the Republican conference stood behind Kevin McCarthy, but due to such small margins in the House, a vote of basically 5, 8 members were able to unseat the speaker for the first time in history.
Jennifer, I was reading a story interviewing some of the supporters of Congressman Gates in Florida, and they were very supportive of what he was doing. And they were saying, basically, the system hasn't worked for us. Throw it all down. Basically, take it apart. Why are there so many voters who essentially want to disrupt the whole system? What's the galvanizing force behind that?
There's a frustration, right? And Washington is but a reflection of a lot of that frustration. These are 435 members of Congress of the House who come to Washington to reflect their constituencies. And there is a frustration. There is sort of a distrust in Washington. And yes, Matt Gaetz has decided to come in front of that and in his expression to try to lead that. But it does actually reflect a concern over a $33 trillion debt, a $1 billion of interest being paid every year, right? I mean, so that frustration is real. Whether Matt Gaetz is necessarily the best to be the voice and the leader of that, I think is an open question.
But the irony of this, Jennifer, is that the longer the government doesn't make a resolution, the more bond yields are going up and the greater the interest expense and the debt profile of this country. So at what point, from a political standpoint, can you bridge that gap to try to communicate that sometimes dealing with the frustrations and the inefficiencies of the system are maybe a more efficient way of getting to the same end? I mean, how do you communicate that politically?
Well, and I think we're going to see exactly that as they negotiate this appropriations process over the next 42 days, right? Because they have until November 17th to either pass another stopgap resolution or to come to an agreement with the Senate on appropriations. And right now, they're still very divided. Whoever is the next speaker is going to have to, as you say, bridge that divide. And I think it's an open question. And over the next week, these Republican members of this conference, from the center to the far right, are going to have to grapple with that question.
Jennifer, do you have a base case on where we'll be November 17th?
I'm concerned, right? I mean, last night was very concerning. And I think there's an understanding within the conference that there needs to be unity among the Republicans if they're going to move forward and have any leeway with the Senate going forward. But it is clearly going to be difficult for any new speaker to work with the Senate, which quite frankly has a bipartisan position on appropriations. So at this point, at this date, I'm rather concerned how we're going to move forward. And I think a government shutdown is probable in the near term.
Jennifer, thank you for your insight, your opinion. Jennifer Flynn there of Invesco. November 17th, Bramo, base case, just to read between the lines there, basically said it at the end, shutdown.
And we heard that from Jim Jordan as well. We heard that from others, that it doesn't seem like there is some sort of resolution. The problem is, and this goes to the frustration that a lot of people have, both in Washington and outside, people are not happy with the way the system is working. But if you just throw it out, you get further away from a solution to the very same problem, which is bigger deficits and bigger interest payments.
Remember the Fitch downgrade?
Yes.
And all the criticism that Fitch got?
Yeah, here's S&P, right?
Even the administration was coming out and saying, what dysfunction?
Exactly.
Come on. Look at the way it's playing out. Look at the way it's playing out now. Coming up on the bond market, Gene Tenuzzo of Columbia Threadneedle on fixed income and this global bond market sell-off. Yields this morning, I have to say at the moment, quite well behaved. Your 10-year, 480 from New York. This is Bloomberg. Yields pop, stocks drop. That's the story of the last 24 hours or so. Your equity market pulling back on the S&P 500. Futures just about unchanged this morning, up by 0.03% on the S&P 500. The S&P, Tom, down almost 8% from the highs of July.
Yeah, I got a drawdown. I mean, the drawdown here is not all that bad. We're not even to correction status here in the equity market. As you let off, John, equity's doing better than bonds as a general statement. I got a negative 7%, negative 8%, Dow doing a little better than SPX. But what's surprising is NASDAQ. You know, I expect negative 8%. I expect NASDAQ to be negative 10, 11, 12. No, NASDAQ's holding up because of those profit machines, which aren't going down like the others.
I'm with you. Given the moves we've seen in the bond market, back-to-back double-digit gains on a 10-year yield, a move of more than 20 basis points Monday, Tuesday. Thank the manufacturing ISM. On Monday, on Tuesday, you can maybe thank job openings or thank everything, all of the above. Yields are higher by 2 basis points this morning. Let's call it 482. Came very close to having a little look at 490. But let's frame this move as follows, Lisa. This is a 150 basis point move from the post-SVB failure lows. That's how big this move has been. And remember going back to spring when we had conversations day after day, again and again repeatedly, about the potential for the end of the cycle. Here we are with yields 150 basis points above those lows.
It's defied all expectations, including those who said something would break at this point, and we've heard that again and again. Maybe things are starting to break, but doesn't seem like it, really. I just was laughing when you said, here we are. A tame move, 482. Yesterday at the same time, you said, bumping up against 470. I mean, it just gives you a sense of how fast we're moving here.
Exactly. The speed of movement, and fast is a really important word. It's a famous David Malpass word. The bank, I looked it up. The bank rate 30-year, I was shocked, 7.88%. It's like jump condition towards 8%. And what's amazing to me is the 30-year bond, John, you mentioned correctly, at 2-something a.m. this morning, it popped to 5.00, take it out to, we do 3 digits here at Bloomberg, 5.009%. The world changes.
It feels like 5 minutes ago, Lisa, to your point, we were literally discussing how historic it was to get yields back in the 440s on a 30-year, that we hadn't seen this in something like 10 years, and we're just taking out each and every level so quickly at the moment.
Which is the reason why it was interesting to me that Margie Patel, her argument for stocks is that we don't know whether this yield rise is over. It could rise that much more. And we could actually see more material losses because of the supply issues, because of the dysfunction in Washington, D.C., because of what we're seeing with robust economic data, and that could still allow stocks and riskier securities in the bond market to keep advancing. Is that the case? Really, this is, to me, the key debate heading into the fourth quarter.
Let's wrap it up with foreign exchange. The euro against the dollar against the yen. The euro showing a bit of strength, the dollar a touch of weakness. The euro 105.07, that currency pair positive 0.4%. The dollar was stronger against everything in G10 yesterday, with the exception of the Japanese yen. We can have a conversation about why. Dollar yen's 149.15. It breached 150 briefly. The why. There's a lot of suspicion that the Japanese authorities stepped in. They won't confirm or deny. Dollar yen, the chart speaks for itself, Bramo.
100%.
Doesn't it?
Confirm and deny is basically also confirming it.
The chart, I think, confirms something happened once we breached 150.
I think that would be true. I looked at 2 oddities, John. I looked at South African rand, and it didn't get out to a 20, which is a round number. But what I really looked at was loonie. Canadian dollar is extremely well behaved, where it weakens from a 135 out to 1.42. It gets pointy and stochastic, where Trudeau dials 1-800-BIDEN and says, oops.
And no one picks up.
We're now at a 137 on loonie. Amy, it's USD, CAD is loonie. That's different from CAD USD, which is the tourist dollar. That's a long story. But the answer is we're not out to panic yet on some of these pairs.
You missed the joke there, Tom. Never mind. Under surveillance this morning, the underappreciated, unprecedented removal of Kevin McCarthy as House Speaker, raising fears of a government shutdown with the next deadline a little over a month away. McCarthy losing his post after Republican hardliners revolted against his decision to compromise with Democrats to avert a shutdown last weekend. The House expected to host Speaker elections next week, with the next shutdown deadline looming on November 17th. AMH just around the corner to weigh in on some of this. But the bond market moves. some might argue are connected to what we're seeing down in Washington. Treasury Secretary Janet Yellen casting doubt on a higher for longer rates environment, saying this: people are trying to figure out exactly what it's going to take to keep inflation moving down. And the economic resilience that they see maybe suggests higher for longer, but we'll see. I think it's by no means a given. Lisa, when I heard this yesterday, I just thought, is that a wish, a prayer, a hope?
It's a put.
Or is that actually a reaction?
Well, it's not a put because she doesn't have that power to make it a put anymore. She has to keep borrowing. She maybe has to go over and plead over at the Fed to maybe buy a little bit more, but they're not going to listen unless they want to be accused of some sort of political interference. Right. There's a question here, though. At what point is there a real problem that Washington recognizes as they watch bond yields climb higher?
There's a feeling it might be right now. More data a little bit later going into payrolls, more key jobs data out this morning. ADP report, 8:15 Eastern time. The median estimate in our survey calling for payrolls to rise by 150,000. Comes on the heels of that JOLTS report. The JOLTS report, Tom, really, really strong, much higher than expected. Speaking to resilience in the labour market ahead of payrolls on Friday.
Some people suggesting there's some variability, some instability in JOLTS, and of course ADP we all know is a soap opera, but yeah, all of a sudden with everything circling here, including the speaker battle, the jobs report, you should tune in, folks. It's like the Super Bowl. We'll be there. It's like,
It's a Treasury sell-off looking for a reason. I'm with you. There's lots of flaws in the job openings data. The way they survey that data, responses to it, the fact that it's much easier to post a job opening. Maybe you should put more weight on the quits rate. The quits rate has come all the way back in.
Right.
But you put it together with the ISM manufacturing, we'll get services a little bit later, and the data's been better than anticipated.
Over the night, just quickly here, I did some analysis, and there's a new voting member at the Fed, Michael Barr. Michael Barr is a new voting member as of yesterday, and how we went from control to the beginning of a free fall. The policeman at the Fed, Michael Barr, is the one. He's a new voting member. He's going to call up Powell. He's going to say, you got to be kidding me. Let me show you the evidence that we see out there.
Looking at the banks?
The banks, absolutely. Okay. They always, Bernanke 101, look at the banks. That's his research at Princeton years ago. When in doubt, how'd we screw it up in the 30s? We didn't look at the banks. Bernanke 101. Michael Barr's a voting member as of today. Gene Tenuzo could be a voting member someday, or a governor. Global head of fixed income at Columbia Threadneedle. He's surviving the wars. Gene, there's a point where it switches from yield analysis to price analysis. Are we there?
It does feel like we're there, Tom, certainly. You're talking about it earlier. The sell-off we've seen in the long end of the yield curve is equal to the amount of work that the Fed's done at the front end of the curve all year. They've only raised interest rates by 1% through the course of this year, and maybe 25 basis points more. But the risk premium that we've put into the long end of the curve is really what has taken investors by surprise, I think, here, because it doesn't seem to be driven by the fundamental data. We would argue that the most important fundamental data of the last couple of weeks for the bond market is the fact that core PCE inflation, the Fed's preferred gauge, came in below expectations and is trending towards that 2% target. And yet we see this steepening, and I think that should give investors pause and think that really there is a fiscal risk premium coming back into the Treasury market.
Gene, have you changed your mind on that in the last couple of months?
Well, I think what we've been doing, John, is really trying to focus more on what we call the belly of the curve, or that 5-year point, where we think we've priced in more than a fair path for the Fed funds rate and more than a fair higher for longer situation. And you have yields basically from the 3-year point all the way out to the 30-year point sitting right around or just below 5%. And for that same yield, we'd rather put our money in the 5-year point, where you're more looking at what the Fed might do and less worried about that term premium or that risk premium, which we learned last year in the UK gilt crisis that can get away from you pretty quickly.
Gene, you think we've got the ingredients for that kind of outcome?
I really don't. I think it's a very different market. The depth in the U.S. Treasury market is significantly greater than what we see in gilts. But, it's that time of year, and it was just a year ago we were looking at what was going on in the UK, and that budget dynamic really did create scare across the market, and international investors drove yields higher quite rapidly. There are some similarities, but I do think the depth in the Treasury market is very different.
Gene, when we talk about the rest of the markets, aside from treasuries, you can look at stocks, which have been remarkably resilient in light of some of the recent moves. You can look at credit starting to maybe show a little concern, but largely holding in. Does this indicate to you that the rest of the risk complex can actually sustain yields that are rising at this pace to these levels? Or do you think that there is yet to be a wake-up call that is coming?
No, I think the wake-up call is coming, Lisa, quite honestly. And we're starting to see that in liquidity of credit. It's starting to deteriorate and spreads are widening and bid offers are widening. So it's a little bit of that unfavorable dynamic we saw for a lot of 2022. And this week that started to reemerge. So I think that credit investors are getting nervous. And frankly, they realize that lags of monetary policy may be long or variable, but they do exist. And at the end of the day, companies and consumers are borrowing at much higher rates, and that's going to cause cracks throughout the system.
Are you seeing things actually break or force selling or anything that seems like a catalyst, or just a little bit more fear that causes a little bit more caution in investments?
I think it's more fear overall. Fundamentally, investment-grade companies, for example, are very cash-rich, and their cash flow profile is stronger than it was in 2019 before the pandemic. So I don't think there's anything that's going to disrupt that, from yields going up 1/4 to 0.5% in a short period of time. When we think about highly levered companies, and for example, look at the fact that CCC, those highly levered companies that have returned over 12% through the course of this year to date, well, they're going to be really susceptible to higher borrowing costs. And as we go forward, I think that rally is going to be hard to sustain.
Gene, let's go back to Minnesota finance just a few years ago. There's a chapter there. When it gets like this, look at the banks. You've got the advantage of Columbia Threadneedle that you're not representing a major bank directly in that, which is our advantage this morning. Are you stressed about the banks? Are they too big to fail, those regionals below them, and critically, the commercial real estate block below them?
I think most importantly, we feel really comfortable with the global systemically important banks, the sort of the big issuers here in the U.S. And we've actually been adding exposure since March through now to that complex. And we think that they're exceptionally cheap relative to their industrial peers. As you get down into the regionals and some of the tier below that do have more of that commercial real estate exposure, I think you do have to be a bit nervous. I think there's a degree of capital raising that's going on in that next tier of bank, but that's frankly, it's been orderly in terms of investors being able to lend that capital. But I don't think we should be so confident as to say we'll never revisit any of the volatility that we saw with SVB.
Gene, when you say you're adding, how are you doing that?
Yeah, I mean, we're adding in the new issue market and in the secondary. I think, looking at, the big, JP Morgan and Bank of America type, capital structures where, the capital profile has already been fortified post-financial crisis, unlike the super regionals that are having to add that capital now. So these are names that, over the last 6 months, we've been adding to portfolios. And, frankly, I think that they're good alternative relative to potentially more cyclical corporate exposures.
Gene Tenuso. Gene, thank you for the insight. Gene Tenuso there of Columbia Threadneedle. On credit at the end, the banking stress we saw earlier this year, the financials really struggling, some of those big names, those bank stocks. KBW Bank Index cannot get off the mat. It's rolling over again towards the lows of spring after the failure of SVB. My big takeaway from that conversation, though, Bramo, that fiscal risk premium that you've got to start thinking about. Now, from people like Columbia Threadneedle, this is not something we talk about with Gene Tenuso. Gene would say, yeah, we've talked about that for years. It's not a problem right now. Now it's starting to be something that really resonates with people in fixed income.
Which to me raises the specter of when does Washington start to watch the Treasury market more aggressively? I mean, seriously, because there's actual practical costs. Goldman Sachs did a survey. They actually increased, just from their survey in July, they increased their expectation for the federal deficit in the U.S., the fiscal deficit, $100 billion just simply by the move in yields by 2025.
Yeah.
So it gives you a sense of the real hard cash behind some of these moves.
I said it yesterday. How close are we to politicians just waking up in D.C. with a chart, the 10-year yield?
I mean,
after the moves we've seen,
I feel like they should be, because right now they should be.
Than John, they
right,
will.
But at
Congressman
some point,
French Hill is.
Yeah, and maybe others will start to join.
We'll see. Coming up very shortly on the financials, on the banks, just a really sensible, sober voice for the financial stress earlier this year. Chris Marinak of Janney Montgomery Scott on the financials. Chris is going to join us next from New York. This is Bloomberg.
One view is that it may take a longer period of somewhat higher interest rates to control inflation, to keep it down, but medium-term interest rates will go back to more normal levels. It's also possible that longer-term interest rates will be higher than we thought.
U.S. Treasury Secretary Janet Yellen, speaking of the Fortune CEO Initiative Conference, maybe this is the return to normal, the old normal. What kind of normal are we talking about going back to, TK?
She's in a tough position.
Big time.
I mean, she says anything she says, and she gets second-guessed from all the way down the mall. I mean, there's just no other way to... What do you think of that, John? I mean...
Look, not a whole lot. I think we need a real conversation about the fiscal debt issue in the United States. But if you're the Treasury Secretary, you're in a tough spot, because if you start to entertain that conversation, you start to lend some weight and credibility to it. And I'm not sure they want to do that right now.
The people in the theater yesterday know that people don't vote on fiscal policy. That is a cardinal rule of American history. They may talk about it, but they get to the first Tuesday of November, they walk in the booth and they're voting about, something else. It's not about the debt.
There hasn't been a price for the dysfunction in Washington for a long, long time. And given the unique privileges that the Treasury market has in global finance, they've had the privilege of acting recklessly for a long, long time in Washington.
Seniorage has been huge.
Without a doubt.
On many different levels.
And it feels like very quickly, just quickly, Tom, slowly then fast, what you're starting to see is that privilege has been chipped away at. And I said that to French Hill earlier this week, the congressman from Arkansas. And Congressman Hill basically confirmed that's what he thought, that they were losing the privilege to act recklessly. And they've got to do something about it. And based on what we saw in Washington yesterday, doing something about it is going to be very difficult.
Thrilled that Congressman Hill will be with us here in a bit. Lisa, your thoughts. What did you observe in the spread market? Did you see moving from convexity to free fall in spreads?
A bit of widening. Basically, the cost of capital is becoming a fundamental concern, not only for the U.S. government, but also for companies. Suddenly it matters. And I think you're seeing that in the spread market as well.
We're going to try to dip into the banking industry right now. Lots of different voices we can speak to here, including at Bloomberg Intelligence. Jenny Montgomery Scott of Philadelphia. Christopher Marinac joins us now, Director of Research. You know the chart, Christopher. I'm going to bring it out. I brought it out before. If Sandy Weil, God love him, was here today, I'd bring it out for him. And it's the Weil Group. It's Citigroup and the train wreck known as their immense boom in financialization. All that love in 2008, 10-to-1 reverse stock split, and we're at $3.90 a day. When does the Eccles building stand up and go, Houston, New York, we have a problem?
Well, Tom, I don't think the credit losses at Citi are tough enough to get us there. They're still trading at a discount to tangible book and have been for quite some time. I think it's been a confidence issue in both the management team as well as the game plan and executing. It may just be too far flung, which I think may have been the issue the past 30 years, and bringing it back home is going to be ultimately the answer. I don't think the credit losses there are wide enough, and I think it's the same issue for the domestic banks as well. We just don't have the credit problems to warrant that level of fear.
Looking at commercial real estate just as one of the fears that are out there on a Wednesday morning. Link in here, Chris, confidence, liquidity, and solvency. Link those emotions of, say, 1998 into where the financial system is right now.
So the banks, Tom, have pre-tax, pre-provision earnings. That's PPNR. It's the central feature of the Fed stress test and really what we all look at as investors and analysts. That cash flow allows banks to build reserves. And we think reserve building is going to continue to happen. It's been strong year to date. We'll be getting again next week with earnings for the big banks. We think reserves will rise for commercial real estate, for C&I loans, for everything. It's what has to happen during this part of the cycle. And then charge-offs will rise. Charge-offs are normalizing, but by the same token, they're going to be much higher in 24 than they were in 2018, 19, and even going back to the 13, 14 years. We're going to retrace old charge-off levels, and that's going to be healthy. We have to recognize risk and we have to recognize loss. I don't think we have anything close to what we had in the great financial crisis era. We just have higher losses, which banks have to provide for. The fear of the unknown in commercial real estate is, to my opinion, somewhat overblown. We still have to reserve for that. And Citigroup has their share of that, and so do all the other banks at all sizes of the spectrum.
Chris, can we talk about the policy response to the banking stress earlier this year? There was a big focus on unrealized losses in the Treasury market. Based on the moves we've seen, those losses are even bigger. Do you believe that these banks are well insulated with the policy response of spring, even with these bigger moves in the Treasury market now?
Sure. I mean, the banks can still contribute to the BTFP bank term funding program. They really have not done much in the last several months. It's still around $108 billion. It's 25% of the incremental borrowings that the industry has done year to date. I think that the liquidity is perfectly fine. The challenge is, to your point, John, is that the losses continue to go up. We think there's another 2 to 2.5% mark on every bank portfolio at the end of September. Wow. So that still is going to make a net negative to tangible book. We estimate today that book values will probably fall about 1.5% for the industry using the KRE or the NASDAQ Bank Index as our benchmark. But that's still somewhat of a nuisance. The banks are still going to be profitable in the quarter. They're just, the profits will not outweigh the mark they have at the end of September. We may find that that starts to reverse as we head into year end and next year, only because we've had such a big move in treasuries. It could simply quiet down. We don't have to have the Fed making a rate policy cut to see those marks start to reverse. In fact, I actually think they're going to start reversing, surely because banks have a lot of 4 and 5 year securities they acquired in 2020 and 21 that are starting to burn off. There's a portion that will begin to burn off, particularly in the next 6 to 12 months.
But still, there is a point here underlying this. The risk is really in some of the reserves, the safety assets, the things that are supposed to be really liquid. And at a certain point, you have to think these banks are incredibly constrained when it comes to new loans with new business. If they have such a huge book of treasuries that they're trying to cordon off and sort of keep from any kind of active trading.
Absolutely correct. I think you will see the loan growth slow down a fair amount in the third quarter and slow again in the fourth. We don't see loans going negative at this point, but for some companies it will. Some companies are on a risk-weighted asset diet, as you've heard. A lot of that is simply machinations about what they're going to keep on their balance sheet, do a little bit less commercial real estate, a little bit different mortgage lending or other loans that have better risk weights. We've seen some companies like Synovus sell medical office portfolios because it's a better way for them to risk adjust their returns and enhance their risk-weighted assets. I think you'll see Fifth Third do the same, and many other regional banks. Those are just a few examples that have announced moves to limit their asset growth.
So, Chris, are you saying that we've seen all the bank failures that we're not going to see anymore, especially in light of some of the very big moves and the constraints on lending?
I definitely agree with that, Lisa. And I think if we have a bank failure, it's going to be a small family-run bank that you never heard of. It's unfortunate for any bank that fails, but we don't see anything big happening this year. We think all of that noise and drama is behind us. The deposits are stabilizing in the industry. The banks are simply struggling with net interest margin and, more than anything else, a perception issue about how bad credit is or is not. I think it's a lot more tamer. We simply have an increase in credit losses, which have been next to zero, and now they're coming off the floor and becoming normal.
Chris, we've been here before. We're going to get a markdown. We're going to get a rework, a redo, a restructuring. And then new money is going to step in at a distressed price. Who are those guys? Who is the new money that's going to step in? Are we going to see foreign money step in, sovereign wealth money step in, private equity? Is Apollo going to own every skyscraper in America?
So, Tom, I think there's incremental dollars in family offices who actually have a fair amount of cash. You know, family offices become very, very powerful. A lot of advisors who used to be at the old First Republic are now at family offices that have reconstituted, and they're competing head-to-head with JP Morgan. And those folks, in addition to private debt funds and other private equity funds, are the new players. We think some of the institutional investors who are on the sidelines will change their minds and come back in, but they'll be followers. The leaders are going to be those family offices and other private equity and private funds. It'll be domestic, but I imagine it will also be foreign as well. I don't think it's just a U.S. Trade at the moment. But the interest is there, and I think they're looking for better prices and opportunities. And clearly, where the KRE is, below 40, certainly attracts them now.
A much more constructive view from Chris Marinac of Janney Montgomery Scott. Chris, thank you, sir. Year to date, the losses look like this for some of the financials. Citi down almost 12% year to date. Bramo, Bank of America, down close to 22%.
I did not know that.
In 2023.
It's a double whammy. You've asked, aren't higher rates good for the banks? Well, not if it necessarily curtails business, and not if suddenly they have a lot of losses on their books of reserves, their safe assets, and that's what they're grappling with. I just wonder what kind of loan constraints they have and how much some of these other other firms are eating their lunch as they pull back from certain areas of lending.
There's some big questions to ask on these calls. 2 Fridays away, bank earnings kicking off with JP Morgan and Jamie Dimon. That is on October 13th. Right. TK, unlucky for some.
I would not have guessed this. I look at BQ screen, the BQ screen. You go C, equity, BQ, BAC, equity, BQ. Bank of America, twice the value of Citigroup, 0.81, under 1 times book. Citigroup, trading like Deutsche Bank, 0.41 on Citigroup.
It's not pretty, is it?
Half the ratio value.
A lot of pressure on leadership over there at the moment. Coming up next hour on DC Dysfunction, Congressman French Hill of Arkansas from New York City on this bond market. The coverage continues.
This environment was clear from early 2022 that we could be back in a 4, 5, 6% interest rate environment.
Rates are a very self-correcting sort of thing.
What we need stability. Rates don't need to go down from here. What we're seeing is the underlying fundamentals are still good.
Businesses are looking at the fact that the cost of capital is rising when they're starting to pull back on investments.
The higher for longer is coming to a reality where the market's been in denial of that.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
A global bond market sell-off for some DC dysfunction. Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio. Alongside Tom Keene and Lisa Abramowicz, I'm Jonathan Ferro. Your bond market looks like this morning. Your 10-year, 480. Your 30-year, briefly, TK, 5% a little bit earlier today.
And it's the way we went to 5% in the last 48 hours, John. I really a great unraveling. I've been doing some math stuff this morning. Let's lose the math. Right now, it's the emotion, and there's a point. Liz Goldenberg, legendary at Bloomberg on fixed income, was really good on this. There's a point, John, I don't care what all the TV bow ties, fancy British ties say, price matters. And we don't talk price because yield's something you can grab. This morning, price matters to Gene Tenuzzo, Jay Pulaski, and everybody else coming up this morning.
We can talk about the price at the long end, that's for sure. There was a 30-year issue, and we've talked about it lots here at Bloomberg. Lisa issued a couple of years ago, trading at below 50 cents on the dollar. A world of pain for anyone who bought that, sat on it, and is now staring at some really brutal unrealized losses.
For the first time, though, in my career, not only are people talking about the price-yield dynamic, but they're just talking about what the yield means for people in Washington, D.C., and you pointed this out really well. Suddenly, for the first time, the cost of capital matters with respect to how policy is executed in Washington. To me, this is the very new story behind some of the yield move that is raising alarm bells, not only in Washington, D.C., or maybe it should be raising alarm bells there, but certainly across Wall Street.
When was the last time I did this, John? The 4 1/8 of August of 2000, not 1953, 2053. Not as long as the Austrian peace, but it's a 30-year U.S. bond. Would you enjoy it from Labor Day, John? You bought it at 98, and you're loving this puppy this morning at 87. Tell
Brutal.
Grandma that.
I know. 2120, that century bond. TK issued a few years back.
Yes.
I think trading in the 30s or something like that. Last time I looked.
It's not as bad as Tucker in radio, but it's like a 101K.
I want to pick up on Lisa's point. I think it's absolutely vital. Columbia Threadneedle, Gene Tenuzzo, talking about a fiscal risk premium in the bond market and talking about it seriously. These have been debates on the fringes for a long, long time. But you'd always get those people in ivory towers that would say, Bramo, it's nothing to worry about. It's nothing to worry about. This from Isaac Boltanski of BTIG this morning. I've used this quote before. I'll use it again. Ousting the speaker in this manner is wholly consistent with broader structural concerns regarding American political dysfunction and the country's debt trajectory. It's not the only reason. It's maybe one of 5, but it's a big reason for some of the moves we're seeing.
I'm curious, if they get a House Speaker and they start moving forward and the government doesn't shut down, do you see yield come in? In other words, does the bond market start to react to what's happening in Washington, D.C. for the first time? I mean, how many years have we talked about, oh my goodness, there's something big going on in Washington, and market participant after market participant says, ignore it. It's always the same old spiel. It feels totally different this time.
Well, maybe it slams the brakes on the economy. You get some bad data and people start buying bonds again.
Okay, that's
big risk is you get some bad data and they don't buy bonds.
Yes.
That's going to be a pretty ugly day if that happens, and let's all hope that's not what we see anytime soon, particularly if you're long risk assets. Equities on the S&P 500 shaping up as follows. Futures right now just a little negative, a touch lower by 0.05%. Yields were much higher than this earlier in the session. We're up by 2 to 481.25. The dollar showing some weakness after dominating G10 over the last couple of days, the last couple of months. Euro dollar here, Lisa, 105.06.
When it comes to what we're watching today, it really is the risk to upside surprise in economic data, because we have seen that as being one of the most disruptive aspects of markets. 8:15 a.m., we get the U.S. ADP job report. 10 a.m., we get ISM services, factory orders, as well as durable goods. Yesterday, that JOLTS figure, we've been talking about it. The fact that there was a surprise increase in the number of job openings definitely jolted the bond market, if you will, because you did see a real response there. Today, we get the OPEC Plus coalition meeting. And really here, what is the outcome when it comes to the proposed supply cuts on a monthly basis? How long are they going to continue with that? Is there a target to crude prices? Around $90 a barrel. This is basically the new normal that they're trying to get to. And Fed Speak today includes Fed Governor Michelle Bowman at 10:25 a.m. and Chicago Fed President Austin Goolsbee at 10:30 a.m., as well as later on in the day. But to me, really, the question is, are they going to respond to the bond moves? How quickly the long end yields has gone up?
They just cancel. Oh, I'm so sorry. Dr. Goolsbee has, it may be COVID, but we don't think so. He's just a little
wouldn't wish that on
weather.
anyone, TK. I will say out of those two speakers, Bowman and Goolsbee, talked a lot about the differences on the committee, difference in degree and maybe not in kind.
Yeah.
The widest degree of difference, maybe Bowman and Goolsbee. Right now, I think I'd say.
Yeah,
Bowman ready to do a couple more, perhaps. Goolsbee ready just to say,
okay,
let's have that conversation about how long.
But what I see
high.
there is Goolsbee is all the social economics of Chicago, the behavioral economics. Bowman has got to be hardwired to what Michael Barr's doing and the Fed is doing to monitor, particularly the smaller banks.
Something to monitor a little bit later. Jay Pawlowski joining us now, principal founder of TPW Advisory. Jay, wonderful to catch up with you, buddy, as always. How, if any way at all, does a 5% 30-year yield change your world?
Well, John, it's certainly been a challenge, right, to be long risk assets as we have been over the last couple of months. We had a great start to the year. The last couple of months have been very challenging, and we've given a fair bit back. But look, to me, we've been bearish bonds for 2 years, right? In our global multi-asset model, we have a 40% benchmark allocation of fixed income. We've been running a 10% weighting in fixed income. We have had 0 treasuries for the last 2 years. So sometimes I get accused of being a perma bull, but we've been mega bearish on bonds. And at 5%, I think we're starting to get interested. We believe that the global economy is in good shape. We're expecting a manufacturing recovery that we think is underway, that's going to support global growth and corporate earnings over the next year. So we remain constructive on risk assets. The bond market has been wrong about recession. The bond market has been wrong about credit risk. The bond market has been wrong about interest rates and cuts and all the rest of it. So I'm not really inclined to follow the bond market. I don't think it's got the right read. And right now it's dislocated. Hedge funds are the most short they've ever been. So I think we're much closer to the end of this run, higher in rates than we are to the beginning. I don't expect 30-year at 5 already, as you say, but the 10-year I think is a better thing to look at, and I don't expect it to get to 5% in this run. I expect the next big move in rates to be down.
Jay, on your global optimism, your Pacific Rim optimism, can you partition all of our worries about China, empty buildings, empty cities, the domestic drama as well, with the reality of 4.x or even 5% economic growth? How do you parse those two emotions?
Yeah, Tom, you were just talking about paying attention to price, right? The way I look at it is, what is in the price? And I think that all the angst about China is well in the price of Chinese assets, particularly Chinese equities. The real estate story has been known for years, right? I think I've said on this show before that anybody that's worried about Chinese real estate is not invested in Chinese assets. They're gone, and they've been gone for a long time. My point is that over the next 6 months, the next 2 quarters, the year-over-year comps for China in terms of economic activity are going to be mega easy to beat in a world where that's not necessarily going to be the case. And why is that? It's because a year ago, China was in those severe lockdowns. And I'll just give you one data point to make the point. Trip.com, which is like the Expedia of China, reported for Golden Week this week, the holiday week, that outward bound bookings year over year were up 20 times, Tom. Not 20%, 20 times. And I'll leave you with this. China has outperformed the S&P, Chinese equity, FXI, which is the ETF we use, has outperformed the S&P over the last month and over Q3. So it's already, the turn is already happening. People just don't want to really believe it. But if you're actually interested in price, the price of Chinese equity has done better than the price of the S&P over the last 1 and 3 months. I expect that to continue.
Yeah.
We're overweight Chinese equities. We're going to stay that way.
Jay, I think there actually are more people coming to your side of the woods when it comes to the China call simply because of where the price is. There is more question around some of your calls around European banks and just banks in general, especially at a time of the pace of interest rate rises and how much that's affecting business activity. Why do you push back against it? Would you be buying U.S. banks on a day like today?
I think Bank of America at these levels is very interesting. I mean, we don't do individual securities. We're ETF only at TPW Advisory. We own and have owned XLF, which is the U.S. banks, the big banks, not had any exposure to the regional stuff. And XLF is down for the year. It's been an underperformer, but it's not been horrible. European banks have, again, outperformed the U.S. banks. And I think that the opportunity is pretty nice. We talked about, again, I think Tom brought up the price to book. You're talking about major banks trading at half a book. I think the price, the risk reward, like I said about China, China is the best risk reward because the risk is already in the price and the reward is significant. I think with the banks, again, half a book for Citibank, I think that's
There we go. Pulaski says, load the boat on Citigroup. Jay, David from Baltimore emails in. David, thanks for watching in Baltimore today. And he says, forget the Super Bowl. November 11th, the victory bell, Duke, UNC, both rated this season. Do you have a chance over the dreaded blue of Chapel Hill?
Oh, well, Tom, I was thinking about you because I was at Duke on Saturday night when I thought we had Notre Dame in our pocket and we're going to have 2 big upsets to start the year. That didn't work out quite well, but it was a fantastic environment for Duke and Duke football. I think all I can say is go to hell, Carolina.
Thinking about TK on Saturday nights. Get a life, Jay. Jay Pulaski, TPW Advisory. Jay, it's good to see you, mate, as always.
English football, balanced time. Did you see Manchester United against a team from Turkey?
Galatasaray.
I watched every moment of the highlights. It was fascinating.
Manchester United just dreadful at the moment. Absolutely dreadful.
I was thunderstruck.
Was that the balance? Was that the balance? I also thought David lived in Brooklyn, not Baltimore. But good to know. Good to know. Thank you, sir.
I don't know. Thanks, David, for watching. He's in Baltimore.
If you're just joining the program,
waiting with the Orioles.
Welcome. Your S&P 500. Positive here by 0.1%. Yields now just about unchanged after seeing some big moves overnight. We're back below 480, so there we are. 479.78. Yields absolutely unchanged after some major moves over the last couple of days. Gains of more than 20 basis points Monday and Tuesday on a 10-year maturity. On a 30-year, briefly through 5%, pulling back just a touch now. We're down about a basis point at the long end. Dare I say a little bit of calm after the storm? 491 Bramo on a 30-year yield.
At least not an escalating storm. I mean, I think that maybe that's the feeling. Maybe we're getting a sense of some sort of buying or some sort of plateauing. But it's early days because, frankly, the way that the sessions have gone, as the day goes on, selling in treasuries continues.
Wait for the data.
Right, wait for the data, which we're going to get, and then also wait for what happens in D.C.
Well, after yesterday, that's where I want to go, but I'm going to note we have further disinversion this morning. The fact is we're way under 40 beeps, negative 34 basis points coming from pre-emisor negative 100 all the way up to negative 34. And every pro says this is the instability that matters. But Lisa, I take your point. I'm looking at a plethora of data, John.
Lisa's right to talk about DC. you've talked about the historic nature of what's happened in Washington. A word I've heard is unprecedented. Typically, when unprecedented is used, you're thinking about the majesty of the moment. You're thinking about maybe how devastating something might have been. There's something very, very clumsy, Lisa, about how unprecedented this moment is in Washington.
Clumsy because there is a lack of a leader, a lack of a session in the House for a week as they try to figure out who their leadership is going to be at a time of some really serious questions and potentially a government shutdown.
On the latest dysfunction in Washington, D.C., Bloomberg's Anne-Marie joins us next, live from New York. Good morning.
All eyes turn to the U.S. job market.
The jobs report, it beckons.
It looks like companies are just holding on to workers.
What you see is what you get. We're seeing a lot of strength.
This Friday, Tom, Jonathan, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
This is exactly what the Fed is looking for.
They now believe you can get back to 2% without damaging the labour market at all.
We might get a bigger whammy than we expected.
The September Jobs Report, Friday on Bloomberg Television and Radio.
It's the benefit of this country that we have a better Speaker of the House than Kevin McCarthy. Kevin McCarthy couldn't keep his word.
Our government is designed to find compromise. I don't regret my efforts to build coalitions and find solutions. I was raised to solve problems, not create them. I believe I can continue to fight, maybe in a different manner. I will not run for Speaker again. I'll have the conference pick somebody else.
It's going to be very difficult to find compromises now. Representatives Matt Gaetz there, Kevin McCarthy, moments after the historic House vote to remove Kevin McCarthy from his position as House Speaker. Live from New York City, welcome to the programme. Equities turning around here in the last 10, 15 minutes or so. Equities just about positive now on the S&P by a little more than 0.1%. Yields turning around as well. They were much higher than this earlier on in the session on a 10-year. We're now lower by a basis point, 478. On a 30-year, we were north of 5% briefly, back down to 490 and lower by a couple of basis points on the session. With that, the dollar weaker, the euro stronger, 105.15 on the euro against the dollar. Tom, that currency pair positive by 0.5%.
I'm watching currencies today, and they're out off that, and again, under 149, 148.85 on yen. I guess that's what we're watching there. Maybe it's off the radar after the bond festivities that we see. And again, I'm going to go, John, to 210 spread, showing me continued disinversion this morning. And as Lisa mentioned earlier, 8:30 is a big deal. This economic data jolt what we saw yesterday.
I like the pun. I appreciate that. Job openings, yes, that was nice.
I nailed that. McKee talking.
So Monday, look, Tom, Monday data was decent, better than expected. The ISM manufacturing, that contributed to the sell-off we saw in Treasuries. Job openings also contributed to the sell-off in Treasuries. There's just a feeling from a lot of people in fixed income at the moment that this is not just about the data. This is about other things as well. Yeah. Point to China, point to Japan exiting yield curve control, point to QT if you really want to, but also point to the dysfunction down in Washington over the last couple of months.
A dysfunction in Washington, and Pennsylvania Avenue, folks, is a lot like Sunset Boulevard in Los Angeles. If you were to be, like, for instance, at 601 Pennsylvania Avenue, NW, that would be the Capitol Grill, and holding court there at 5 p.m. is Joe Matthew and Anne-Marie Horton. You can look out and also see the Anne-Marie Horton billboard as you head up to the Capitol. She joins us this morning here on Her Washington. Anne-Marie, open question. What was your insight on the theater as you went to your program last night?
Well, there was a ton of theater, right? There was this rule procedure brought to the floor to potentially delay the motion to vacate. Speaker McCarthy lost that. He lost 11 Republicans in that vote, and then it really set in motion potentially for a quick ouster. I think Speaker McCarthy thought potentially daring this hard right flank to ouster him, basically, as the Wall Street Journal editorial board is calling it today, cut off their own heads, the Republican Party. Right. He thought maybe he could shore up some of these votes, but he had 8 of them that voted against him alongside Democrats. Right. The theater really, I think, is what was going on behind closed doors and in the hallways. I wasn't there, but what you're hearing from reporters in our building and also on Twitter was that even some individuals were crying. These are people who I cannot explain how chaotic it is right now for the Republican Party. And they're going on recess, but nothing can get done on the House of Representatives floor until they have a speaker. And that's going to take at least
a week. Capture Anne-Marie at the Capitol Grill at the bar. They're watching Balance of Power. capture for me the
They do.
mood.
We're on the TVs there.
Capture the mood at the Capitol Grill last night of their Washington flat on their back.
People are stunned. The Republicans have control of one chamber of one branch of government, and yet they have dissolved it, basically. And it is very chaotic. This is the first time in history, not the first time in history there was to be a motion to vacate. Remember, Mark Meadows put in a motion to vacate for John Boehner, but he resigned. We have been here before with the Republican Party in the fact that they put pressure on speakers, on their leadership when they don't get their way from the hard right flank of their party. This is the first time in history that a Speaker of the House has been ousted. And we have this pro temp speaker, Patrick McHenry, chair of the Financial Services. We know him well. He comes from a list that Speaker McCarthy made, this pro tempore list Speaker McCarthy made that only started after 9/11 in the event of a terrorist attack to make sure we have continuity of government. So we have this one speaker, but his only point of legislation right now, the one thing he needs to be able to do on the floor is for the Republican Party to elect another speaker. And there's a lot of names that are being thrown around, but no one has a hold on the party right now.
It's important to sort of highlight the procedural power of a House Speaker, because it's more than just someone who can bring everyone together and buy pizza for everybody. This is about somebody who can actually bring motions to the floor and get work done with outrage. Right. So
this
talk
is
about
third in line to the presidency.
So give us a sense.
To the presidency.
So give us a sense of just what can't get done without a speaker.
I mean, the government will likely potentially shut down or be where we were this weekend come November 17th. If they don't have a speaker, they are not working on the 12 appropriation bills, which Firebrand Congressman Matt Gaetz constantly complains about. He calls them single issue spending bills. They're not exactly single issue, but those 12 appropriation bills. They cannot look at potentially sending more aid to Ukraine, which President Biden got on a call with allies yesterday to say the U.S. will continue to support Kyiv. They cannot look at potentially more forces, more money going to securing the southern border, which is not just an issue for Republicans, but a lot of Democrats and Democrat-run cities. And nothing can get done on the floor until there is a speaker. And at the moment, it's uncharted territory for this Republican caucus.
There's an issue with money, too, and a lot of times money speaks when we talk about the political game. Where are big businesses in terms of donations and in terms of trying to influence the conversation at a time of great dysfunction?
Well, it's interesting you bring up money because Speaker Kevin McCarthy was a prolific fundraiser. He has a ton of cash on hand, not for personal use, for his personal reelection, also his campaign PAC. And he could decide who he wants to go support and not. I mean, if I was these individuals that voted to ouster him and teamed up with the Democratic Party, I would be very nervous about where he decides to spend his money next November.
AMH, thanks for the update. As always, Anne-Marie down in Washington, D.C. Just a headline crossing over in the United Kingdom I wanted to share with you that Prime Minister Rishi Sunak has had to cancel the northern leg of the United Kingdom's high-speed rail project. This is HS2. TK, it's gone way over budget. It's gone way over budget. What he's saying is that he's vowing to spend £36 billion in other transport projects. The ultimate issue here, though, is the whole reason for this project was to link the south with the north and level up, so to speak, to do something about why the economic north was so much poorer than the south. And Tom, to close that gap, you were going to have this high-speed rail line that would go from London, Euston, all the way up to Manchester, really fast, cut the travel time down tremendously. And they're cutting the northern leg, which kind of undermines the whole reason for making it in the first place, considering you can travel pretty quickly from Birmingham to London already.
I mean, it's unfair to say, what are your thoughts on this per se? I mean, everybody's going to have a different opinion. How will this be received by conservatives and liberals across the United Kingdom?
Well, conservatives in the north will be deeply upset by this. So how that additional money gets spent in the north is going to be a big issue, particularly going into the potential of having an election in the next 18 months or so. My personal feeling about it, this railway line goes right the way through the field in front of my mum's house. Absolutely devastated the countryside.
So it's this is like a Japanese high-speed train in China. Why China's doing this? I've taken the high-speed train, Tokyo to Kyoto, etc. Why can't United Kingdom do that other than through your mother's front yard?
Forget my personal issue around this. This is another reality check for the Prime Minister constrained fiscally in the United Kingdom. again, another big reality check.
Come on, you go to name 6 banks and they refi the deal and you charge a fair toll, a fair fee to go.
What John just said there is really the big takeaway. It is an incredible example of how the money really stops at a certain point, especially when you've got borrowing costs going up and when you have a real argument for fiscal constraint.
Is this because Man United lost?
It's
last
because
night
Manchester United are terrible. That's right. They lost the
guy from Southampton said that. They'd never do this to Southampton.
We need to talk about some strikes, and we'll do that next. We'll catch up with Ian Lingen of BMO from New York. This is Bloomberg. Equities on the S&P 500 positive here by 0.1%, slightly elevated in the stock market. Looking at the Nasdaq right now, up by about 0.07 after some big moves yesterday, taking us back down to the lows we have not seen since early June. The S&P down almost 8% from the highs at the end of July. In the bond market, monster moves over the last couple of days, more than 20 basis points higher on a 10-year. Back-to-back double-digit moves after non-manufacturing, or rather after manufacturing ISM. We'll get the services ISM a little bit later. Also after the job openings number, yields up and away. 480 something earlier, 478 right now, down a single basis point. The 30-year north of 5% earlier in the session. Now back down to about 490 and down a couple of basis points on the day. I want to turn to foreign exchange. The euro against the dollar against the yen. The euro 105.10. That's a stronger euro or weaker dollar. Dollar yen breached 150 briefly yesterday. They won't confirm or deny whether the Bank of Japan, the Ministry of Finance, jumped in and did something about it, but we're back down to about 148.92. The gap lower on the chart, I think, Tom, just speaks for itself. It's screaming something happened once we breach 150.
Now, something happened, and we'll see how it plays out. But the answer is, I've said, sequential interventions are weaker and weaker. It's like a nice dampening function out. And I certainly felt that yesterday. It didn't have the jolt of the first intervention of a number of months ago.
Under surveillance this morning, the unprecedented removal of Kevin McCarthy as House Speaker, raising fears of a government shutdown with the next deadline a little over a month away. McCarthy losing his post after Republican hardliners revolted against his decision to compromise with Democrats to avert a shutdown last weekend. The House now expected to host Speaker elections next week, with the next shutdown deadline looming on November 17th. And a feeling, Bramo, we're not going anywhere anytime soon in Washington.
The clock is ticking, right? We have fewer than 40 days left. We have no session in Congress for the next week or so as they try to get some sort of leadership lined up. Unclear who's going to win the speakership given the rigmarole that Kevin McCarthy had the last time around. So where does this leave us? Is this bond market responding to that dysfunction? And that's what we've been asking throughout the morning. Does anyone care in Washington?
Certainly was that feeling that it was responding to some of that overnight, that's for sure. Gene Tenuto, Columbia Threadneedle, one of those we've spoken to who thinks that's what's happening at the moment. I want to turn to the commodity market. Oil easing ahead of an OPEC Plus ministers meeting today. Individual statements from Saudi Arabia and Russia saying they will stick with earlier announced production cuts through the end of the year. US stockpile data due at 10:30 Eastern will update the latest on already declining crude inventories. We're talking about operational minimums in certain places here, Lisa. That deficit is the reason we're back near the 90s.
Some of the physics behind this, that basically the sludge at the bottom of the tank makes it less efficient to really pull out and have a good grade. I mean, this is where we're at based on just how low these inventories have gotten. The question that I have is, in a couple of sessions over the past couple of days, the idea of higher yields has led to the idea of perhaps more weakness down the line, which has put a lid on some of these oil prices. Do we hear OPEC Plus justifying further cuts by saying, look, we could see weakness because guess what? You've got really strong economic growth, and so there's going to be a yield response. And, it's such an uncertain circumstance. We don't want to oversupply things.
Crude, TK pulling back over the last week or so.
I need news. As always, you got a wide set of opinions. Rule number one, never predict crude. It's the toughest thing to predict in the world. And, I'm just going to let it play out. We were at 100 OMG. We're going to 120. No, Ed Moore says down, and here we are.
I think we've said that, haven't we, before? If you want to make a fool of someone, ask them for an
I've
oil
learned
forecast.
that the hard way. I mean, I'm not like Bramwell. Bramwell had the 2 barrels in the living room, was killing. She had like 3 years of tuition off that play.
Let's finish on the strikes.
And
Ford
bills.
raising its offer to striking UAW workers. In a statement, the automaker is willing to raise pay by 20%, increase 401k contributions, and offer as much as 5 weeks vacation. UAW is still looking for a 30% hike in wages, a return of traditional pensions, and commitments to electric vehicle battery plants. On the strike front, Lisa, healthcare strikes in America.
This, to me, is the most interesting thing. This isn't a one-off, excuse me, when it comes to auto workers. This is also something broader. We're seeing strikes also this morning. Kaiser workers launching the largest U.S. healthcare strike across the U.S. 75,000 workers walking out on strike at Kaiser hospitals across the country today. This is a theme. And at what point does this give rise to the feeling of a wage price spiral or something more, with the tightness in the labor market being something other than just robust economy, but really a lack of workers for the jobs at hand?
And I would suggest that October is considered by experts a great reset on price change in medicine. So we may see some interesting sub-data.
3-day strike, Tom. 3-day strike.
Right now, futures up 5. We are thrilled at the quality of our guests, as we were thrilled, say, 3 weeks ago when Ian Lingen showed up and said, load the boat. He's head of U.S. rate strategy at BMO Capital Markets. Without question, our bond discussion of a day in bond crisis. I'm not going to give you like a joke, if you loved it then, you'll love it now. But Ian, I want you to take all of your experience and say, how did this price decline in fixed income filter into the financial system? How does it filter into our banking system?
Well, I think what's been fascinating about the recent repricing is that we haven't seen the type of response in risk assets that we might typically. Given the magnitude of the backup in 10-year yields, I would have expected equities to be off more than they currently are. And I think to some extent, the market is looking at this move and saying it's temporary. We're going to have dip buyers come in and we'll reset to lower rates. What I worry about is if this sell-off ends up being sustainable. Envision a world with 10-year yields above 5% for a sustainable period of time. Real rates now in the 10-year sector are at 240, 245. If that stays there, we're going to see some far more material ramifications for the direction of growth, consumption, and consumer borrowing.
Last time we spoke, I said to you, is this 10-year a screaming buy? And you thought it was a screaming buy. Mm-hmm. What have you found difficult about this move since that conversation? What's behind it?
So I think that the most interesting aspect of going from 435 to 485 was the fact that, for all intents and purposes, there's a buyer strike in the Treasury market. It's not a situation where there are aggressive sellers. It's not a situation where most investors have changed their fundamental belief in the way that monetary policy functions, but rather the resilience of the real economy has left most investors in the Treasury market on the sidelines, and no one is willing to jump in front of this and grab the proverbial falling knife.
Tell me whether you think the DC dysfunction is contributing to what we're seeing. I'm hearing from some people that they think it is. Do you agree with them?
Well, it certainly isn't helping. I think the reality is that what we're dealing with at this moment is the fact that up until this week, term premium was effectively zero or negative. We're now to the point, at least according to the ACM model, where term premium in the 10-year sector is at about 22 basis points. When we looked back at the 2001 episode, term premium peaked in 10s at 35 before quickly correcting into the negative 60 range. So there could be a very sharp reversal in the offing soon.
So if a few weeks ago you thought it was a screaming buy in the 10-year Treasury, is it even more of a screaming buy now, given how much more higher we've gone?
I think a fair characterization at this moment is it's the perfect time to be on the sidelines until things stabilize. Eventually, we will look back at 10-year real rates at 240, 250 as potentially a generational buying opportunity. But for now, I'm on the sidelines to be sure.
But why, right? I mean, because if you liked it at 450, why not love it at 480, right? I mean, we're looking right now at yield that we haven't seen going back to 2007 and really creeping up against the highs that we haven't seen since 2001. Why stay on the sidelines if you think eventually it will be the screaming buy?
At its essence, what we're looking at now is we're all as a market waiting for any evidence that the lagged impact of monetary policy is going to hit the real economy during the fourth quarter. We haven't actually seen that. And so if we come out of Friday with a stronger than expected or even a relatively benign payroll sprint, then we focus on Wednesday's CPI, we could see 5-10 10-year yields, and that would be a much more attractive entry point.
Right. Ian Lingen with us here on Bloomberg Radio. Good morning across the nation. John, I'm doing price today. I haven't done this since time began. 5 years. It's called the old on Bloomberg. I don't really, Ian understands it. I don't understand it. You've enjoyed from Labor Day going from 100 to 97 on your assured 5-year piece of paper.
The price destruction has been pretty phenomenal. Ian, there's a lot of people sitting on unrealized losses in this Treasury market. Can you walk us through just how much volume there actually is? You've talked about a buyer's strike. Has liquidity changed? Has volume changed in the Treasury market?
Well, outright volume numbers haven't changed. In fact, the numbers that we track, we are at about 1.4 times the norms over the course of the last 2 or 3 days. But when we see the severity of the price action, the moves really suggest that these are transactions that either need to occur or, i.e., they're just transactional, part of the normal daily flow, as opposed to someone really getting excited about the outright level of rates and taking a shot at going long in any significant size.
I guess what I'm asking, is it still orderly?
At this point, I would say that liquidity is functioning fine in the Treasury market. It's not disorderly. There's nothing that the Fed would be worried about yet. If we find ourselves gapping higher in nominal rates, I think that'll be a problem.
What is the yet?
What is the yet?
When does the Fed get concerned? They're not concerned yet. What would make them concerned?
I think if you get financial conditions back above what we saw in October, November of last year, combined with a material deterioration of the real economic data, that's when the Fed starts to change its tone.
Do you see, this is a sensitive issue because you work for a bank, but do you see bank fragility there? I got reverse 10-to-1 split Citigroup. I've got them at $3.90, trading at 0.41 book. When does Michael Barr at the Fed go, we have a problem here?
That's actually a great question. I don't think that
It's my only good one of the day, so go with it.
I don't think that the banking system is vulnerable for the top 10, 15 banks in the country. I worry about some of the residual from the banking crisis that we saw in March and how that's going to impact the small and regional lenders, and more importantly for the real economy, how that's ultimately going to flow through to access to capital for small and medium-sized businesses. That's what we'll be watching for as the trigger to a higher unemployment rate and a bigger hit on consumption.
On a speculation basis, I mean, we make jokes here about the Austrian 97 years. Since Labor Day, I've enjoyed going from 40 to 34 on that dog. Okay, great. But the answer, Ian, is somebody steps into a 20-year, 30-year zero coupon bond, off we go to the races. Are we at a mood swing now where you can establish a speculative bet that you're going to get a real pop 6 months out?
I think that the market is coming to grips with the fact that we are at very high nominal yields in outright terms, and people will look at a 5-handle on 10 years as the inflection point that the world was anticipating, especially if we start to see more downside in risk assets. That's the biggest wild card.
Getting ready to buy, just not yet. Ian, it's good to see you. Ian Lingen there of BMO Capital Markets. If you are just joining us, welcome to the programme. Equity futures positive here by 0.1%. A turnaround in the bond market, yields lower by about a basis point, at least a 477.89 on a 10-year. There was something a little bit panicky about things overnight once you started to get a 30-year through 5%.
Yeah.
And threatening to go in the same direction on a 10-year.
This feels less panicky, and maybe people will say, well, in Asian hours, funky things happen typically in Treasury market trading. Maybe you could say liquidity isn't that great. Either way, right now we're looking at a little bit more stasis. Things change as the day goes on. What Ian Lingen just said there, though, we're talking about strikes in the healthcare sector. We're talking about strikes in the auto worker sector. We're also talking about strikes in the Treasury buying sector, and that's essentially what it is. Even people who like the yields where they are don't want to step in front of a freight train. And that, to me, what is going to bridge that gap? What is going to really be the circuit breaker on that front?
It was a screaming buy at 4:30. It's not anymore.
Right.
I think there's a real difficulty with this moment, that no one wants to step in front of it And Ian's speaking to that in both this research and in this conversation.
Because why buy it at 480 if you can buy it at 510, right? I mean, there's basically this trajectory in the markets, this feeling that we don't understand and that we're not exactly going to get in the way of this, and there will be a better entry point going forward.
I want to talk about the speculation here, John. This is the PIMCO ZROZ. It's a PIMCO 25-plus year zero coupon bond, U.S. Treasury note, also known as the Alarian Fund. This thing's really worked out since Labor Day, John. It's 83 to 67.
Have you looked at the 2120 Austrian bond?
Yeah, I look at it every morning, thanks, wise guy.
That's trading in the 30s. Worth a little look, TK.
Thank you. It's good to know.
If you fancy it. Andrew Hollenhorst, the City on the US labour market. Next hour.
Are you planning on endorsing a successor to you? And then
I might. Yeah. I don't know who's running yet. Okay. I'll talk to people.
And when you look back, is there anything you could have done differently with those 8 members?
Yeah, a lot of them I helped get elected, so I probably should have picked somebody else.
Congressman Kevin McCarthy speaking to the press after his historic ouster as House Speaker. Live from New York, welcome to the programme. Equities turning positive, a real turnaround in this market this morning. Equities were lower, bond yields were much higher. Turn that upside down. Equities are positive by 0.2%. Yields are now down by 3 basis points, Tom. 476.84 on a US 10-year this morning.
There was history made yesterday in Washington, and we're not going to turn this into a history lesson, but to give you some perspective, and I thought the Washington Post captured it brilliantly this morning with the word rebellion. There are different kinds of Southerners. Newt Gingrich with Sean Hannity last night was heated and on fire, the former speaker with the revolution of 1994. And now we have the immense honor of speaking with French Hill. He's been a good friend of the program. And far more important, folks, French Hill is linked to American finance through his banking in Little Rock. French Hill, how do you link this moment to confidence in our banking system?
Well, Tom, it's good to be with you, and I don't like the dysfunction in the House. Of course, I was very opposed to what happened yesterday, because if we want to continue to build confidence in the U.S. and the U.S. in global capital markets, we've got to show leadership on the fiscal side of the House. And right here in the midst of an appropriations fight and a fight over federal funding, and less than now 40 days to a government shutdown, to be shut down in the House without a speaker for the next week is not contributing to that vote of confidence. So I think they are linked, and I really hate to say that, but this rebellion has come at a very poor time.
The rebellion has a tinge of geography. We had votes from Montana and the rest. And John, I'm sorry. I look at this as a political context of the nation. It's not just about what we're doing at surveillance or the cable TV theater that we're seeing in Washington.
There's a real feeling that the Republican Party shot itself in the foot. Congressman, the question I'd have to ask of you this morning is how can the American public have any confidence in your party's ability to govern?
Well, I think under Kevin McCarthy, the past 9 months, we demonstrated that quite successfully. And that's why I'm so disappointed in 8 people, which represent about 4% of Republicans in Congress. Let me repeat that, about 4% of Republicans in Congress. They voted with all the Democrats yesterday to take down Kevin McCarthy's speakership. But under his speakership, we passed an all-of-the-above energy strategy to make America energy independent once again. We passed border security that both reforms the immigration system that's failed and do border security. And it was Kevin McCarthy, after waiting 90 days for President Biden to provide any kind of leadership, that crafted a historic debt ceiling deal, which resulted in $2 trillion of spending reductions and a 1% cap on discretionary spending. And then just last week, offered a good stopgap spending measure so that we could finish our appropriations work, which also included a debt commission, which I think is so critically important if we want to get a handle on what really drives our deficit. which are our mandatory spending programs.
Congressman, as yields do continue to rise, and I do know that every day you do come in and you look at that 10-year yield and watch it climb in tandem with the interest payments of the U.S. government, Goldman Sachs is estimating that yields climbing where they are add about $100 billion to the deficit come 2025 versus expectations just in July alone. Do you think right now that other members of your party realize that the longer this dysfunction goes on, the more they contribute to that deficit?
Lisa, it's such an important question, but I want to really turn it around and say, yes, I think every day in the last few weeks, we've talked about the impact on fiscal finance and rising interest rates with our House members. But this is a fundamental issue that goes back to both pre-pandemic and certainly during the pandemic, when the Democratic House Budget Committee chairman at the time said there's no limit to what America can borrow from the world and spend at home, and deficits don't matter. And that went on steroids during the pandemic, ostensibly to help offset the output loss during the pandemic. But we did 5 or 6 times what that output loss was, and we didn't take our foot off the accelerator. And President Biden's compounded that. So it's a bipartisan
hold on a
problem
second.
to do this.
But Congressman, I mean, to be fair, the deficit did rise by about $8 trillion during Trump's time in office, and it actually accelerated during that period, and a lot of the aid was accelerated during that point. So isn't this both parties, and the fact that there's complete dysfunction now just exacerbates the inability to really address any of these issues, which is a bipartisan issue?
No, I just said that. I said during the pandemic. Well, that's the Trump administration. Absolutely. We had spending out of control there with an eye towards trying to offset the output losses during the pandemic. The Globe did that, but we overshot, plus too lax monetary policy for too long. We've lost our way. I want to go back to when both parties said that zero deficits were the objective, not $2 trillion, which is Joe Biden is projecting. So sure, both parties bear full responsibility for this, but what I've seen in my 40 years of being in private business and in and out of government is there is no consensus that large deficits are bad in the Democratic Party and some in the Republican Party, and that's what's got to change.
I would suggest, Congressman Hill, that you and former Speaker Gingrich are sort of on the same page. Well, this is embarrassing. Let's fix it. The way to fix it is an anointed Speaker of the House. How long is this going to take?
Well, I hope, Tom, I would have hoped that we could have started that process before we left this week, but we didn't. And so we're going to meet either Monday night or Tuesday morning early and start the process of selecting a new speaker. And I want to have that concluded next week. It's very important that we get on with our work in this midst of this appropriations fight that we have on our hands with the government shutdown looking us in the eye for November 17th.
Congressman, this is a difficult question. It might be somewhat emotional for you. Has your party left you behind? Do you get the feeling that this is not the Republican Party that you joined and it's moved away from you?
I think the Republican principles of balanced budgets, a strong defense, international leadership, the largest open market in the world that attracts people all over the world. These are core principles, loyalty to the Bill of Rights and the Constitution. These are still fundamental tenets in the Republican Party, but I think we've lost our way tactically. We're throwing overboard a successful speaker that shares those views, absolutely shares those views, and was guiding us through the stormy waters of a dysfunctional presidency led by Joe Biden and a Democratic-controlled Senate. Not easy to do with no plan. Those 8 people who voted to throw Kevin McCarthy out yesterday, incorrectly in my view, don't have a plan except they're complaining about the fiscal conditions of the country. Well, that's shared by all Republicans. So tactically, I think they failed. Strategically, I think the individual principles and governance that's guided the Republican Party are still intact. We've just got to move forward and regroup and find a leader that we can get behind.
It's certainly shared by the Republicans, the majority of Republicans in Congress. But, Congressman, is it consistent with the views and the beliefs of the dominant leader in the presidential race for your party going into next year? And I think overwhelmingly the answer to that is no, isn't it?
Well, I think President Trump believes certainly in a lot of those principles, and I've seen him do good work when he was president. But we need him to help rebuild this and not run counter to it. We need to have the Republican Party on the same page when it regards our role in the world and our role at home on how to do that. And President Trump had challenges on the spending side too, and yet he was good on some other things. So we've got to get together and focus on the House in the next few days and get a House leader that Republicans can back so that we're back in this game of countering the Biden's failed agenda on the border, internationally and fiscally.
Congressman, just finally in 30 seconds, is he helping you or hurting you now?
Who?
The former president.
I don't think he comes into play in this issue in the House. What we've seen is these 8 people are not doing Trump's bidding. They're concerned about the fiscal affairs of the United States. I get that. They did not trust Kevin McCarthy. I don't agree with that, but I understand where they're coming from. This is an internal matter that we need to solve in the House, and we need to get a leader that we can get behind, as I say, in order to counter the mistakes and the direction of the Biden administration.
Congressman, thank you for your opinion, your view this morning. We appreciate it, as always, French. Congressman French Hill there on the latest in Washington. Live from New York City, your equity market just about positive on the S&P 500. It's a bit of a turnaround this morning. This is Bloomberg.
If we don't know where the top rates will be, we don't know where the bottom of the equity market is going to be.
Spreads will gradually move wider into the end of the year, but we are forecasting a more narrow range.
I think the potential for an accident is there, but these higher rates ultimately are going to bite.
There's a lot of risk going forward here, and the market's only now starting to price it in.
You could definitely end up between 5 and 6 on the 10-year. I think it's more likely we're going to head up towards 5.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene on radio, on television. An historic morning for America. Yes, the politics of Washington, but far more in 14 minutes, John. Once again, we're data dependent as bonds are priced lower.
Can we make it 3 for 3? ISM manufacturing, better than expected. Job openings higher than expected. ADP report just around the corner. Tom, going into payrolls on Friday.
It's a trend of hard data, soft data, all the other stuff Michael McKee talks about. He'll be with us. We're going to come to you commercials free through this hour. Keith Lerner in moments, and then a guy named Hollenhorst is scheduled to show up to tell us about Powell in the put. Secretary Yellen yesterday, very chairman-like. I believe we had a Yellen put tossed into the landscape.
I believe that was a hope, not a forecast. Yeah. That higher for longer is not a given. Given the backdrop, Tom, you've got to talk about the context. Those comments are coming at a time that you've got a bond market selling off pretty aggressively, up 150 basis points from the post-SVB failure lows. TK, back-to-back double-digit gains, and a real concern that this is not just about the Federal Reserve. This is not just about the economic data, not just about Japan and exiting yield curve control, not just about China and the difficulties they've got, who perhaps are selling treasuries, but also about the dysfunction in Washington and the budget deficit and the inability, not just the willingness, the inability to get a hold of it.
And what everybody's doing, folks, and within the financial ballet, it's about yield. We've tried to give you in crisis the price analysis. Lisa Abramowicz is expert at this. What is the price analysis of the two movable parts of a spread this morning?
Well, of the bond yield. It's price down, yield up, and you can see that with credit spread as well. It's basically when you have the risky aspect of the company go up, you see credit spreads go up. And you are seeing that because right now people are looking out there and saying, if borrowing costs go up this quickly, you start to have a fundamental concern about what kind of price you're going to have to pay to refinance. This is the issue. If prices of borrowing go up, if rates of borrowing go up enough, it becomes a credit risk just because it doesn't make sense to borrow money and refinance at some of these rates, Tom.
Farrell this weekend out looking at real estate across the island of Manhattan. How about that?
Not so much.
John, how about that 7.88% 30-year mortgage? Are you kidding me?
I haven't seen numbers like this in more than 20 years. Manus Cranny's moved over to New York. Welcome, Manus. He's doing a great show at the moment with Danny Berger at 5 a.m. in the morning. Good for him. I'm looking forward to catching up with him a little bit later. We've been talking about mortgages in America, Tom. Real estate in the United States. He's looking at buying in New York. I was like, good luck. I said, Manus, the problem is not just that rates are high. It's that prices haven't come down. That's the issue right now in real estate. So sure, I mean, you'd pay like 8% mortgage rates, whatever. I wouldn't be too bothered about that if prices had come down 20, 30%. That's not what's happened, because a lot of people are sitting on mortgages that have got a two-handle on them, Tom. Suppliers, we know, is an issue in a lot of places, including in New York City. And this is the thing about long and variable lags. In the housing market, super long. It's like 30 years. The high yield, which is what Bramo's talking about, that's on the horizon, near term, next 12 months. There's a lot of companies that need to come back into this market and refinance. And they're going to refinance at rates that look nothing like the rates they financed at a couple of years ago.
When you take Manus out, I mean, is the dead rabbit enough of an Irish bar downtown, or is that just, that's like American Irish? It's like, it's really not.
That's a bit of a stereotype.
It's a stereotype.
I wouldn't take Cranny to an Irish bar.
You're not going to take Cranny to
New York.
To
I took him to a diner. We had breakfast. You were there.
Yeah, well, that was, he wasn't really here yet. Now he's more here.
No, he was here.
But
he
it
was
wasn't
very
offensive
much
enough.
Physically present.
Lisa, this redounds to speaking of Ireland. I looked at Irish prices. Manus says I should live next door to Bono, however you pronounce it. The real estate prices in Ireland are insane, and this is a global moment. We've really been focused on America, but the German 30-year or UK gilts, et cetera, they're all in the same disarray.
There's a tension right now because there is a lack of supply of homes and there is an increased demand as people come of age to actually make families and move out of their parents' basement. And so you do wonder at a certain point where it breaks. And there is a theory out there that when rates start going lower, you start to see supply come into the market, and that's when you see housing prices fall, because you actually get price discovery. You actually have a market. 2-10
spread, John, to get the data going here. It's been a little better in the last hour. We had continued disinversion early morning, early surveillance morning. Now negative 37 basis points is still stunning.
Massive turnaround, but let's talk about where that disinversion, is that what we're calling it?
Disinversion is
coming from.
Priya Misra told me that.
It's coming from the long end selling off. It's coming from 10-year yields going aggressively higher, 30-year yields going aggressively higher. And that is not the steepness we expected, the nature, the character of it. What people were looking for this year was economic downturn and yields falling at the front end. So the front end rallying off the back of bad economic data. Haven't seen much of that this week, Tom, going into payrolls on Friday. Your price action looks like this in the equity market on the S&P 500, turning just a little bit higher by 0.2%. In the bond market, yields are lower now by a couple of basis points. Tom, let's call this 477.
Vixen under 20. Crisis over, 19.76. Expert at crisis measurement is Keith Lerner, co-CIO, Chief Market Strategist of Truist Advisory Services. He will get us to ADP this morning. Keith, you've got so many competencies, CFA, CMT. Which chart speaks volumes to you this morning?
Yeah, well, great to be with you guys. I appreciate the new title. I could use a new one. You know, as far as what speaks volumes, I mean, obviously we're focused on that 10-year, right? The 10-year needs to stabilize. Everyone's watching that as the first thing that they look at when they wake up. But, you know, believe it or not, Tom, you know, we have been more in the correction camp since late July. And believe it or not, I'm actually becoming more positive, given that we have all these carousel of concerns, but we've had a pretty good correction. We have now 8% of stocks above the 50-day moving average. That's down from where we were in July, where about 87% of stocks were above the moving average. So the most oversold condition. Everyone's watching this 200-day moving average. I actually would prefer that we break below that, believe it or not, so we get a little bit of a deeper flush. But I think all in all, you know, at least, you know, all these negative things that we're talking about, they're right in front of us. If you get any relief on any of these things, I think you can at least have a little bit of a catalyst for the market.
To swing from technical to economic, do we get a Powell put? I mean, we've got Andrew Hollenhorst coming up from Citigroup, but the basic shock moment will be some form of communication from our central bank.
Listen, I think it's premature. I don't think we're close to a Fed put as far as even from a market standpoint, 5 or 10 or 15%. I think, you know, they have scar tissue from this inflation of the last year, and they're likely to continue to talk somewhat hawkish and also not likely to cut rates anytime soon. So I don't think this is a Fed put. I think really what the market needs and what we've been lacking is upside catalyst. So we're getting through this tough period with all these different headlines. I think we have to get closer to the earnings season. The Atlanta GDP number, which probably is overstated, is still at 4% plus. So the earnings season should be okay. I think that could change the mindset of all these other things that we're talking about.
Keith, you're getting more constructive on stocks. What about on bonds? What about on treasuries, given how quickly the yields have moved up and given the fact that a lot of people think that it's truly compensating you for at least inflation risk?
Yeah, well, listen, to be fair, the bonds yields have moved further than we've thought, pretty much more than anyone in the business has really thought. I would say at this point, as we look at it at this point, we're at 480. There's a band of historical resistance in 5 to 525. And to answer your question, yeah, I think as far as someone with a 6 to 12 month time frame and longer, we think that the bonds risk reward is becoming more attractive. Because even if bonds go up to 510, 525, because of that carry, that higher yield, you'll more than offset any losses and still have a positive yield. Positive total return on a 12-month basis, even if the yields got up to 520. And I think at this point we've had a pretty straight move up. So I think a little bit of I think 5% will be attractive to a lot of investors.
This is fascinating to me, Keith, because Ian Lingen of BMO Capital Management also came on and said the same thing that you just said. Going to sit on the sidelines, a beautiful place to be while you wait for it to get to 5% or 5.10, and that's sort of the threshold for them to come in. At what point, though, does this really send the stock call off sides? At what point does this become disruptive outside of expectations, just simply because these are losses that we have not seen before in the bond market?
Yeah, it's the biggest risk to anything constructive. And within our overall asset allocation, we are more neutral in line with stocks, bonds, and cash. But if we were looking for more of a pullback and now we're getting it and the news flow is negative, I think that's a time to at least lean in if you're underweight to go closer, closer to, as far as increasing equities. And then the point about waiting for the exact time, I think it's better to look at things from a risk-reward standpoint, knowing you're not going to hit the top and bottom. And the final point is this. There is a high cost of certainty. If everyone's waiting for that moment, that will happen very quickly. So I think you have to start to move in when the risk reward becomes more attractive as opposed to trying to call tops and bottoms.
Keith, I did some work on a blended bond portfolio this morning. The name of it doesn't matter. It's world famous, blah, blah, blah. And basically, bonds are a train wreck, breaking down on new, Bloomberg total return, whatever, breaking down to new price lows. But when you inflation adjust the total return of bonds, it's an unmitigated disaster. I'm going back in my math to January of 2009. Is the Great Moderation fractured where retirees in America can't catch up who were sold a yield story?
Well, I think this. Folks that bought bonds at lower yields, if they bought long-term bonds, they're still getting that coupon. They're just not getting, the adjustment, as you mentioned, for where inflation is. But hopefully, as those bonds mature, they're going to be able to reinvest at higher prices. And the other point I would say is this, too. Looking forward now, if you think of a balanced portfolio, something like a 50-50, on a 5-year historical basis, it's been up 99.6% of the time. And now with yields resetting, restoring value, I think the outlook for a more balanced portfolio actually is much better than it's been for some time. So again, yes, someone who's bought yields at lower prices, not great, but again, you're going to have an opportunity to reinvest at much higher yields.
When it comes to the stock market, there's been a real question about where the leadership will come from. A number of guests on the show have talked about how tech will retain its leadership, others saying it will broaden out. Based on what we've seen over the past week, it's flipping and flopping depending on the day. What do you think is going to be the leadership going up for the 6 months?
Yeah, well, that's been one of the problems why we were a little bit more cautious recently is because there was no leadership. But as we move out of this, I think two areas that we would focus on as far as from a sector standpoint is more of a barbell approach. We still like energy. Energy has the strongest trends in the market. Valuations are cheap. We all know, there's a supply production kind of a cut that's supporting those prices as well. So I would look there. And then also communication services on the tech side. That's where some of the AI companies are as well. They have some of the strongest trends. Hasn't really broken down during this correction. So I think coming out of this, those are the two areas that we would focus on.
Hey, Keith, thanks for the update from your desk. Thank you, sir. Keith Lerner of Truist Advisory Services. On the latest data, the latest market moves. If you are just tuning in a couple of minutes' time, we get the ADP report. It's like a bad appetizer for the payroll report on Friday. People say they don't care about it, and then they trade on it.
It's like Marmite.
Don't ask me why. Your equity market going into it is positive by 0.2% on the S&P. The estimate is 150,000. The previous number was 177. With us around a table going into this number is Andrew Hollenhorst, the chief US economist over at Citi. Andrew, good morning to you.
Good morning.
Can we make it 3 for 3? Manufacturing numbers were good. The ISM on Monday. Job openings were higher than expected. We'll talk about whether we should pay too much attention to that on Tuesday. This Wednesday into Friday, you expecting more strong data?
Yeah, I think we will see more strong data. I mean, if you look at the kind of underlying pace of job growth, we're running maybe 150,000, 200,000. You have some seasonal adjustment factors that are going to come in there, and we think it's going to boost the number a little bit on Friday. So we think we're going to come out actually above 200,000. The unemployment rate is where I would watch Friday. I think that can come down to 3.6%. And
wow.
That is going to be concerning for Fed officials.
Is this economy, and I know this is tough to answer with any real confidence, but do you think this economy is starting to reaccelerate going into year end and not slow down?
I think that's the risk, and I think that's probably the concern for Fed officials right now, that you still have a very tight labor market. The previous guest mentioned it. Atlanta Fed GDP now 4.9%. At Citi, we're tracking growth in the third quarter at 3.2%. So just empirically, we are accelerating in the third quarter. I'm not sure how long that lasts for. I'm not sure that that's sustainable, but that's going to add some inflationary pressure to the economy.
It's how we started the program this morning, Andrew. We were talking about risk cutting both ways. We're coming into Q4 and we're talking about a consumer-led slowdown potentially, but also at the same time simultaneously having a conversation about the potential to reaccelerate. Can we talk about the former a little bit more? I know your base case is the latter. We get one more hike from November Fed meeting because of the risk of that playing out. But just the slowdown, why do you not lend too much weight to the risk of a consumer-led slowdown, given what's happened with energy recently, what's happening with student loan repayments, where rates are? Why do you not lend too much weight to that story?
Yeah, I think the economy will eventually slow down. I don't see it from the consumer now, and I don't see it from the consumer because we just don't see it. It's not there in the data. You see not only services consumption that's continued to hold up, but we're getting stronger goods consumption. People are buying autos. People are buying houses, even at higher mortgage rates, even at higher prices. So there's a lot of strength in that consumer.
Andrew, sit tight. It's timed it perfectly. The ADP jobs report about to drop in a couple of seconds' time. The estimate 150,000. To bring you that economic data, let's cross over to Mike McKee.
Well, good morning, guys. We get a number that is a lot lower than people anticipated. Just 89,000 jobs created in September, according to the folks at Automatic Data Processing. Annual pay up 5.9%. That's a drop. So it looks like at this point a weaker than expected jobs report could be a possibility. We always have to add that could be disclaimer when you're talking about ADP and its relationship to the government payrolls number. Now, remember, these are private sector jobs. By industry sector, goods producing 8,000 jobs. Manufacturing, ADP says, loses 12,000 jobs. Construction gains 16,000. And only 81,000 jobs in service providers. Leisure and hospitality leads that with 92,000, but we see 32,000 in professional and business services decline. Now, remember, yesterday we got that JOLTS report that showed a big rise in job openings in August for professional and business services. So there are some disjointed data going around here. One last thing, the change in establishment size, small businesses, 95,000 additional jobs. Large businesses lose 83,000 jobs. Pay growth slowed. Job stayers up 5.9%. Job changers 9%. And remember, the quits rate didn't move, so people are still looking for other jobs, expecting to get paid more. So bottom line, 89,000 jobs were created according to ADP. We'll see how that affects everybody's forecast for Friday.
Might stay close. We'll get into the data ahead of Friday as well. This move, this data goes against the grain. Better than expected data Monday, Tuesday, downside surprise Wednesday. And this is the move in the bond market. Yields lower, Treasuries rally. On a 10-year yield, we're down about 5 or 6 basis points to 473. It is 8:17 a.m. Eastern time, and we've already had a 15 basis point trading range on a US 10-year yield.
Another day.
Much higher a little bit earlier. We were pushing 490, and now we're back down to 470 something. On a 30-year, yields were 3.5% earlier on this morning. They're back down to about 487, down about 6 basis points there. Off the back of that move, equity spiking higher. Near session highs, positive by about 0.3% on the S&P 500, and the dollar, which has been absolutely dominating the bulk of G10 with the exception of the Japanese yen in the last 24 hours, shown some weakness now against the euro. 105.17, that currency pair positive by, let's call it 0.5%. Tom, that currency pair near session highs.
Much more than normal, John. And folks, you just simply look at the blinky of the Bloomberg Launchpad, the red and the green, the amber on the screen. And John, there's a lot of action there. There's people adjusting.
Adjusting,
where
adapting.
we are. Yeah.
Downside surprise, 89,000 on ADP. The estimate 150. Looking ahead to payrolls, this is the number we're looking for. 170. The previous number 187. To McKee's point, after a number like that, are we going to see some upgrades to the forecast or some downgrades going into Friday? Andrew Hollenhorst of Citi with us around the table. Andrew, your reaction to that? What would you expect on Friday now based on this? Does it change anything for you?
It doesn't change anything. I think just look at the scatter plot of ADP versus NFP. There's not a high correlation between the two. So it's a big if we get this number. If we get this number, though, like Mike McKee said, it's a big if. But if we get this number for payrolls on Friday, this is Goldilocks. Right around 100,000 jobs per month. That's about what the population growth can sustain. That would be a very sustainable pace of job growth. So if we see this number, that would be a Goldilocks economy.
The heavyweight, Janet Yellen, was out yesterday with some select comments that I'm sure your team saw as well. There's another economist, Michael Tyson, who has a very famous quote about getting punched in the face. Everybody's got a plan here. How does the Fed, with the trauma that we've seen the last week in the bond market, I'm sorry, there's a point here where the Fed put comes back into place. Are we anywhere near where the Fed looks at the financial trauma and says, we got to adapt?
So remember what the Fed is trying to do here is to raise interest rates and slow the economy. They've raised policy rates, but really what controls the economy, mortgage rates, corporate borrowing rates, those are going to be dependent on the 10-year yield. So the fact that 10-year yields are higher, I think, is probably consistent with what the Fed is trying to achieve. Now, like John was talking about earlier, being in a 15 basis point trading range over the course of an hour or so in the day is probably not the level of volatility that Fed officials would like to see. So they're watching this, as Fed officials, government officials always tell us, they're watching. And they'll be watching for, do we see signs of liquidity stress that are emerging? If you saw those type of things, then yes, I think you could think about, would the Fed actually react to this? And first it would be with their rhetoric saying that, maybe Treasury yields have moved too far, but I think we're still away from that point. Treasury yield curve is still inverted. We still have 10-year yields below 2-year yields. They've come up a lot. We're not as inverted as we were. If you're not imminently looking at a recession, you're not staring down a recession, it's not clear why that yield curve needs to be as inverted as it was.
A number of people have come on this show have said that a lot of the move in yields has not been fundamentally justified. Do you disagree? Do you think that fundamentally where the yield is currently on the 10-year Treasury and the 30-year Treasury is completely justified and compensating you for inflation?
I think it depends on what you mean by fundamentals. But if you're including in those fundamentals the fact that we're running large deficits, there's more Treasury supply that's coming to the market. So some people would call that a technical, but I would say that is a fundamental structural part of the U.S. economic backdrop right now. And along with that, we're running higher inflation. And you were just talking about this earlier. If we're running inflation that's above 4% still by a lot of measures, it's not that surprising to see Treasury yields above 4%. You need that yield just to be compensated for the inflation that we're running.
Do you think dysfunction in Washington helps the Fed's cause?
I would not say that it helps the Fed's cause. I don't know if it helps anyone's cause right now. The developments, it does raise questions about whether we're going to be in another shutdown November 17th. And you saw markets that were trading that. You saw markets that priced out some of the probability of a Fed hike in November. I think what the Fed wants here is for the government to stay open, which would allow them to respond to the economic data and not what's going on in DC.
That is a fantastic answer. Well played. Very diplomatic. You use my favorite phrase in the whole of global finance from policymakers. We're watching this.
That's right.
And we often ask on this program, what does that mean? What on earth does that mean if they say we're watching this?
It means they have a Bloomberg.
Seriously? Andrew, stick around. We're going to get a final word from you in a moment. Mike McKee, I know you're staying close as well. You've had a second look at the data going into Friday. What do you see?
Well, of course, we compare ADP to the private sector job creation numbers because ADP doesn't do government. And if you look at what is expected on Friday, the private payrolls is expected to come in at 155. Not a whole lot of strength. That's down from 179 the month before. So ADP has got maybe the direction economists are thinking right, but they are still significantly below that level. So it will be interesting to put those together with government, since government is now still open, and see what we get for a total. Market participants seem to be saying that if we get a real outlying number, that could have an effect on what's been going on with treasuries, and we haven't had an outlier in quite some time.
Andrew, just a final thought here. Is there an incoherence between the JOLTS data that we got yesterday, the ISM manufacturing read that we got, the fact that in general things have been coming in hotter than expected, and even just the direction of these ADP figures?
I think especially seeing that manufacturing was down in these ADP figures is surprising. We've seen those manufacturing PMI ISMs bottom, moving up. Looks like they're going to move up through 50, and we're going to be expanding in the manufacturing sector. So I don't think that negative payroll growth for manufacturing really makes sense with where we are in the economy.
I look, Andrew, you got to go back. You got to write an 8-page paper with your team, a guesstimate forward. And the heart of the matter is the vector of inflation. I mean, within the dual mandate. Do you agree that we've seen 3-month annualized disinflation? And can you state that we've got a generalized vector that is disinflation?
I can't state that. I wish I could state that, but I can't state that. I think what we've seen is a soft patch in inflation. You had a lot of special factors that came together, auto prices moving down, airfares moving down. Some of those factors are going to go the other direction, and we have a tight labor market.
This is a key insight, John. This is the arch debate on surveillance right now.
240 on Friday still?
Still at 240 on Friday.
Unemployment at 3.6?
3.6 unemployment.
Where's wages?
Wages, we think 0.3%. That's the big question. Ultimately, it does come back to wages. Do we see wages that are slowing down? Or we have them 0.3% month on month? That's kind of holding steady.
How much weight would you put on job openings? Here's so many complaints about that data.
It is not the most high fidelity reading that we have on the job market at all. So, I'm watching the whole mosaic of jobs figures. And if you look at the mosaic, I think it's all telling you it's a tight labor market.
Sounds like an audition for the FOMC, that, doesn't it? Andrew, stick around. Andrew Hollenhorst of Citi is going to stick with us. In the next hour on Bloomberg TV, Brian Levitt of Invesco is going to be joining us. Jim Bianco of Bianco Research to weigh in on what's developing in this bond market, and some reaction to the price action as well from Mandy Su. SIBO. Looking forward to all of those conversations in the next 60 minutes or so, next 90 minutes on Bloomberg TV and Bloomberg Radio. Bramo, big turnaround of the bond market then. Yields lower now by 3 basis points. They were much, much higher earlier on today.
Yeah, but they were much lower yesterday when we started the day, and it really depends on what we get from ISM services data that comes out at 10 a.m. It is interesting, though, this stability, does it lead to more buying because it gives people some confidence that they're not catching a falling knife? There's sort of a psychological aspect to this that we heard from Ian Lingen, who called 10-year treasuries a screaming buy, now doesn't like them because of what's going on, just simply because he thinks that he has a better entry point.
Wasn't that a month ago?
Yeah, that was a month ago. Screaming buy.
I just did a great function, John, the trading envelope in the Bloomberg. We've had a dramatic pullback in yield in the 10-year yield. Guess what? We're still out at 1.9 standard deviations move. It's just a little bit of a move there.
It's a quiet move.
It's just a non-move.
Downside surprise on the ADP report, 89,000, the estimate 150. From New York City this morning, good morning. Stocks are higher.
I'm not data dependent. Bramo's data dependent. Welcome to Bloomberg Surveillance. John Ferro preparing for an eventful 9 o'clock hour. Futures up 10. They reverse VIX 20. Fear crisis 19.56. An improving VIX as well. I'm watching 2's10 spread, the vanilla spread, as Andrew Hollenhorst calls it. And the 2's10 spread is rapidly improved, negative 34 basis points as we await in the 9:45 hour, the 10 o'clock hour, a Michael McKee wall of data. Michael McKee joins us right now to make sense of all this. Help me out at 10 a.m. Bramwell will be watching. I won't. Like, what matters at 10 a.m. in this volatile bond market that we've seen?
Well, the ISM numbers are probably going to be the most important thing. Durable goods comes out, very volatile series, of course, and a lot depends on Boeing. And so that won't get quite as much weight for people in the markets, I think, as the ISM services number. People will look at the headline, but they really want to see, as we did on Monday with the ISM manufacturing numbers, they want to see the prices paid number and the employment number. The employment numbers will help people kind of make sense of ADP here. And we'll see what prices paid tell us, because we had a big drop in prices paid for manufacturing. So is the story that the economy is relatively strong. The labor market is tight, and prices are still going down, which means the Fed doesn't have to do anything else? Or do we see a different story, the converse?
In the soup of employment data that we get this week.
Oh, I like that, soup.
I'm curious. You like soup. I like soup too. Well, yeah, exactly. I'm curious about this idea of the strikes and the labor movement that we've seen, not only in the auto sphere, not only when it comes to what we've seen in Hollywood, but also today, starting with the Kaiser nurses and 75,000 workers who are going out and strike for 3 days. At a certain point, how does that feature into some of this employment data, both not only with some of the jobless claims, but also with respect to wage increases?
Yeah, well, jobless claims are going to start to get distorted, and we're not going to be able to pay a whole lot of attention to them because you'll have strikers in there. If you're on strike, you can't get claims. You can't claim benefits, but if you're laid off or can't work because other people are striking, you can. And so that's going to distort the jobless claims numbers, make it hard to read anything into that. We won't see really anything in Friday's report on strikes. We've already got the strike report from the BLS, 17,000 people on strike, and even that's overstated because they solved the writers' strike. So the UAW strike won't show up until this month. Now, the nurses' strike does start before the reference month. So if it goes through the week of the 12th, in the pay period, including the week of the 12th, then we will see a big impact on the overall numbers. The Fed is going to look through all that. They'll pay more attention to what the settlement numbers are to an extent.
One more question to get you to 9:45 and 10 o'clock. As you know, the Richmond Fed always is written on the history of the country. John Mullen, brilliant on writing about the advent of the Greenspan put. Folks, this is just after the McKee put. And the McKee put was 1998, where they said, oops, there's a problem, and the Fed behaviorally, action-wise, stepped in and changed. Are we anywhere near the Yellen put or the Powell put as we observed yesterday?
Well, that's kind of the open question that keeps coming back around in the markets is, do people think that the Fed will have to do something? And the Fed is trying to tell everybody there is no Fed put left. We're not going to do that. We're not going to get involved. And any time we get some market ructions, people start thinking, wow, the Fed will step in. So the only way they can prove themselves is to not step in. And so we'll have to see.
We're going to stagger here to the end of the half hour. We've got three guests lined up that are just, it's all of what surveillance is about. Ralph Ancampora will join us here in about 15 minutes. His brilliant call on a bull market coming out of October. He's truly legendary. Also legendary is Ira Jersey of Bloomberg Intelligence with his work on fixed income. And at our table in New York today, Andrew Hollenhorst of Citigroup. Ira, you're a bond guy. You're hauled into Hollenhorst's office, and he says, what is going on in your market? Talk economics, fixed income guy. What do you say to the economists about the price action in your space?
So a couple of things. First, I want to comment on your question about the Fed put, because I do think that there is still a Fed put. It's just it's way far out of the money, right? So the idea is that you'd really have to see some serious both market pain and economic pain for the Federal Reserve to seriously react. I think in the rates market, the link to the economy is still incredibly strong, and one of the big reasons, and even a bigger reason than has been espoused about supply and high deficits, is really the much better than expected economic data that we've received. So by our estimates, and we put out a note this morning about the relationship, about 70% of this move can be explained by the better than expected economic data, and I think that's really important to realize that it's still the economy, stupid, right? That's still always going to be the biggest factor for the Treasury market.
Lisa, I did the work yesterday on DXY and the Mother Star, going back to Plaza Accord, and as Ira brilliantly says here, you got to do the work about, okay, where would the stress click in? It's amazing on strong dollar, where all of a sudden the dollar becomes a put. We're distant from that. We really got to move up on dollar strength to get action.
I've been thinking a lot about this, right? And what Ira said there is both financial market stress, but also economic stress. And Andrew Hollenhorst with us here as well. And I'm curious from your vantage point, how constrained the Fed really is to step in and lower rates or to make any actions whatsoever in response to financial market distress. Because in the economy, it is the economy, stupid, and the economy is incredibly strong, and we're still seeing inflationary pressures.
Yeah, like Ira said, there's a bar at which the Fed would come in and do something to stabilize markets. that bar is higher because you have this backdrop of inflation. When you're in a situation where you've run above target inflation for multiple years, which is where the Fed is, and trying to get that back to the 2% target, it's an additional constraint on coming in with any kind of dovish policy movements, dovish policy actions, dovish policy rhetoric. And as you heard just yesterday, some Fed officials saying, Atlanta Fed President Bostic saying, we might just keep rates high for a very long period of time. And that was in the midst of a historic sell-off in treasuries.
So it seems like Fed officials are kind of leaning in almost to what we've seen in the longer end of the Treasury curve. Ira, from your perspective, we've heard one guest after another say they don't want to catch a falling knife. They're not going to want to step in here. They're going to wait for better levels. And they're viewing maybe 510, 525 on the 10-year yield as some sort of entry point. Do you see the same kind of technical signals right now in the market that that's where we're headed, all things being equal?
So 5.3-ish%, 5.34% is the next really important technical level. And, you have to go way back, Lisa, because as you know, and as Bloomberg's pointed out quite a lot the last couple of days, is that we're at levels we haven't been at since before 2007, right? So when we think about where the 10-year yield becomes kind of a value play, it really becomes, a question as to what is the terminal floor, right? So the big thing that the market's now priced is not just that the Federal Reserve might leave rates at 5.5%, 5.75% for the next year, 18 months, but more that when they cut, they might only cut to 4%. Now, I think that's wrong, and I think the market probably is being way too optimistic about that. But when these kind of moves start to gain momentum, they keep going until kind of you go the other way, right? So we haven't yet seen complete capitulation, I think, by long investors, by investors that really want to be long the market here. So the path of least resistance is still for higher yields near term. I think there will be a pretty interesting buying opportunity in the next month or so, but it's hard to say that's where we are today.
Pro tip, most important conversation at Citigroup today is not Jane Fraser. It's Andrew Hollenhorst, and you're going to wander by crack security analyst Keith Horowitz. And there's going to be a Hollenhorst-Horowitz conversation, and it's going to be about how all of this eco mumble-jumble floats over to the banking system. How do you as an economist synthesize Keith and his team's worry across different capitalizations of the banking structure?
So Keith Horowitz is actually my neighbor in New Jersey, so I run by his house. He comes out the front door and we talk about these things. So that will probably happen.
Dogs in the neighborhood run away.
Yeah, we're the only two people who want to be in that conversation. But no, I think that's exactly the question we should be asking. With a large upward movement in Treasury yields, fixed income investors are taking losses, and where are those losses showing up, and what does that mean for the different investor segments?
Right.
That is something to keep in mind.
This is gospel, folks, at UCLA, where Hollenhorst studied, Axel Leonavood and that. Forget about yield and all this financial media garbage. It's about price. When do people like you at the Eccles building, like Michael Barr, start worrying about price in bonds?
Yeah, so there's a price conversation, there's a yield conversation. If you look at the price...
And they're two separate.
And they're separate conversations. Yeah, that's right. And that matters. And look at what the Fed has done with the Bank Term Funding Facility, for instance, where you can now deliver a U.S. Treasury to the Federal Reserve, $50 Treasury, and you'll get $100 back from the Federal Reserve.
Yes.
Why did they put that in place? They put that in place because they recognize that these Treasury securities have taken losses. There needs to be some kind of backstop for those losses. So it goes back to Lisa's question. The Fed is standing ready to do something if something needs to be done. There's just no indication right now that something needs to be done.
What about quantitative tightening? How much of what we're seeing in the long end is because of that, Andrew?
It's hard to really ascribe this to quantitative tightening in terms of this move, because that's been going on for some time. It's been going on without a big effect on markets, in the sense that you've mainly been draining liquidity out of the reverse repo facility, which is just kind of excess liquidity. But, and it's an important but, as the Fed drains reserves from the system, as quantitative tightening goes down, it means deposits come down at banks. And when deposits come down at banks, it means banks don't have those liabilities to go out and buy assets. What are the assets they're buying on the other side of that liability? Treasuries, mortgages, long duration assets. So that is one natural buyer of treasuries that probably would have come in and backstopped this market that can't, because quantitative tightening is going on.
Ira, from your perspective, do you think that that's a concern at all for the Fed, sort of the amount of liquidity that they're draining out of a system that has seen an incredible amount of volatility?
Well, I think that the Federal Reserve is concerned about, when will quantitative tightening have an effect on the overall financial system, right? I think there's some people who think that the Fed and want to actually continue runoff even well beyond when when we think that they'll ultimately have to start to ease up on the quantitative tightening. And ultimately it really comes down to how much liquidity does the banking sector need. So our work suggests that sometime in the second quarter of next year, we'll reach the lowest comfortable level of reserves, or what we call the reserve tipping point. Right. And once we get there, the Fed will probably just have to stop QT and just reinvest some of their balance sheet. And that goes down a lot. So things like the bank term lending program, when that runs off, that's an extra $100 billion of reserves that immediately go away. So, next spring will be an interesting time period for quantitative easing. But, the fact that they stopped not quantitative easing, quantitative tightening, but even if they stop runoff, that doesn't mean that they're going to immediately cut, right? And I think they have to then communicate this disconnect between balance sheet policy and monetary policy.
Stay with us. Futures up 12. The Standard & Poor's 500 up 0.3%. And
we are seeing a bit more stability right now in the bond market. 474 down about 5 basis points on the heels of worse than expected jobs numbers from ADP. Of course, that will all get discounted at 10 a.m. when we get the ISM services data, if that comes out potentially in an overwhelmingly positive light.
It's going to be interesting to see. We continue with Andrew Hollenhorster of Citigroup. I'm absolutely fascinated how you do a Q4 look-forward report. Have you taken it from 12 pages down to 7 pages so you don't harm yourself?
I think you're adding pages here as Treasury yields go higher. You have to start thinking about what is this going to do to the housing market, for instance. So we've seen mortgage rates.
Stop there. Come on. Citigroup is knee-deep in this. I got a 7.88% 30-year mortgage. I've never seen anything like this, and it's all about first-second derivative of fixed income elitism by the Fed. I mean, how bad did they screw up our real estate market with a rate of change and rate of change of the rates?
Yeah, well, and it's very complicated now because we saw 7% mortgage rates. We came off of those 7% mortgage rates lower. Now we're going higher again, and we'll probably get above 8% mortgage rates depending on where 10-year Treasury yields settle down. It's been a strange housing market because that's also been constraining the supply of houses. So we actually have house prices that are rising pretty rapidly because nobody wants to lose their 3% mortgage rate. How that supply-demand works out, very uncertain, and that's making Q4 difficult.
You got to come back. Lisa, we got to talk about 8.25% Hollenhorst mortgage rate.
And also what happens when we actually start to feel these rates because people actually start taking out mortgages. Because right now, how many people are actually paying that?
Generous time with Andrew Hollenhorst of Citigroup this morning. Thank you, Ira Jersey, Bloomberg Intelligence as well. Coming up for those in the equity markets, Ralph Ancampora.
We are seeing a bit of a reprieve in bond markets, a bit of calm, I should say, stability after getting a worse than expected ADP report, a better, at least, downside surprise when it comes to a cooling off. This is Bloomberg Surveillance. Tom Keene, Jonathan Ferro Lisa Abramowicz. John's off preparing for the 9. I am watching, though, as we watch 473.50 on the 10-year yield to go out for decimal points. In decreasing by 6 basis points, Tom. This is just showing the incredible volatility that we've seen in the bond space.
It's been it's a bond space, but it's more than that. It's, for one day it correlates with foreign exchange, and the next day it correlates with the Red Sox need to improve, whatever. But even with BitDog, I'll leave that to Matt Miller. But the bottom line is we've done all today, folks. We've shifted from a yield analysis. We're forced to look at price. I thought Hollenhorst was brilliant about this. The media doesn't do this. We love the convenience of yield. And Andrew Hollenhorst said in the Bramo space, price analysis is different and discrete from yield analysis.
Because it really speaks to the holders of huge pools of these securities. Talking about price, I wanted to take a look at a couple names that caught my attention. There was a Wall Street Journal report yesterday that said that Netflix was planning to raise prices on some of its ad-free services in the next few months on the heels of the resolution from the Hollywood strike. Basically, some of these strikes are leading to higher costs down the line that consumers will get charged, which I find interesting. Those shares up 0.6%. We've seen similar type types of moves from Amazon in terms of raising the fees, not only from subscribers, but also for the platform.
Fees,
Well, exactly, they can. And Meta, Facebook coming out and potentially charging $14 in Europe for Facebook and Instagram for people who do not agree to certain information sharing systems.
They raised Prime $10. What am I going to do? No,
well, exactly.
I'm going to cancel.
But this is exactly it. They've got a sticky base of customers. They have pricing power, and they have this. They have, the costs that are going up. Can they pass them along? What we are seeing, at least with initial reports, is they are going to. And this, to me, is one of the underlying fears when it comes to an economic perspective of are we entering something more inflationary, even if we've seen disinflation so far this year?
We have two guests that we really want to speak to in this October. This is away from the bond crisis we see, although we'll get his opinion, all the rest that's going on out there. One of them is Edward Yardeni. He's been doing this a few years, the economist of Yale and C.J. Lawrence of decades ago. And Ed Yardeni, 12 months ago, said, load the boat. Get on board this equity market. With a different approach, co-founder truly of the Chartered Market Technicians and a legend within my world, no question about that. Ralph Ancapora joins right now. Ralph, your call last October was absolutely stunning. Are we still in the Ancapora-Yardeni bull market?
Yes, Tom. Thanks for bringing that up. Last October, it was almost a year ago, October 13th to be exact. From a technical point of view, that was a very, very important climatic day, which led to what we've experienced over the last 12 months, rotation. And I think that rally into June and July was a little bit overextended and was led by the technology stocks, as we know. So we've been going through a correction, but that's the good news. The bad news is that the market doesn't like uncertainty, and that's why we've had such difficulty in the last few weeks, because of the rising interest rates, rising oil prices, this chaos in Washington, D.C. So that's what puts pressure on the market near term.
Ralph, Lawrence McDonald is one of the great essays of 2023. And basically, folks, it's a long drawn Larry McDonald essay on the absolute wall of money that is out there within the global financial system. Ralph, this is different from decades ago. How do you analyze the wall of money that's out there within your technical analysis?
Yes, we watch that very, very carefully, because that flow of funds is what moves markets. And if you'll recall that the first leg of this bull market, up until I'll say June of last year, June of this year, excuse me, most of that money was sitting on the sidelines. It actually came in late, and it was chasing stocks, and that's what caused that accelerated move in June and July, which we're unwinding now. And I think that's a good sign on one hand. On the other hand, we have a test right here as we speak.
There used to be a patience, Ralph Ancapora. When you were on with Lou Rukeyser, there was an understanding you had to have quiet times along the way. The modern financial media is addicted to the emotion in the moment. The great Louise Yamada, years at Citigroup, would talk about distribution. You got to have moments where it's distributed. Do we have that right now? Do we have a point where in the equity markets we're just churning, waiting to get new strength?
Oh, absolutely. I like that comment about distribution. That's exactly what we've gone through in the last month or so. And that's the bad news, because it really did a lot of damage to individual stocks. The good news is that October historically has been a bottoming month. And for those who like to look at the S&P 500 and where its moving average is, it's right about here at 4,200. So I think on a very short-term basis, we'll probably get a pop, a little bit of a rally. But I need more evidence to suggest that we've seen the final low.
Ralph, from a technical perspective, are stocks and bonds moving in the same way?
Yes, in the fact that at least right now, with all of the distortion going on, we're having that bit of a camaraderie.
Well, camaraderie, and there's a question of whether it's also a feedback loop, of whether that there is some reference in stocks valuations, at least, to what we've seen in the bond market. We've heard a number of people come on the show and said, seems like stocks are ignoring the incredible moonshot that we're seeing in yields higher, highest levels going back to 2007. Would you agree, or would you push back and say, actually, most of the stocks have reflected that pretty broadly over the past couple of days?
Oh, yes, I agree with that. I think a lot of stocks have mirrored that, yes.
Do you think that there is sort of a technical level at around 510 to 530 on the 10-year yield? That seems to be what people are looking for the full catharsis that you see as the positive silver lining of this October.
Well, yes, they're saying that, and they're saying that the rates are getting overbought, which they are. And I think that could be the peak, if you will, short term.
Ralph, John Farrell emails in. He's getting ready for his show. And Ralph Ancampora, John wants to go back to 1995. And, of course, back then we only quoted the Dow Jones Industrial Average. And you made one of the greatest calls in the history of the market. Take us back to the Dow in 1995, Dow 5000, when you said go long. Is it the same equivalency right now?
What we had then and what we have today, I think, is a little different. We had low inflation, low interest rates in those days. And that was the spur, if you will, of the late 90s. When I wrote the report, Dow 7,000, when the market was around 4,000. And then when it hit 7,000, I raised it to 10,000. And we look back now, we say, well, that was a dot-com bubble. But at that time, we didn't know anything about dot-coms.
Ralph, thank you so much. Congratulations on a great call, folks. We're scheduled to have Edward Yardeni with us here 12 months after the announcement of a bull market. Mr. Acampora on technical analysis this morning. Do you like that Dow analysis?
No, you really are trolling John, huh?
Yeah, well, John just said with Ralph, you got to do Dow analysis.
Oh, yeah.
That's all that existed
very
back
much
then.
in character.
Until the pension consultants showed up, and then we all went SPX, which is a much better index.
All right.
No question about it.
If you're going to talk about the Dow actually gave up its gains yesterday in response to some of the sell-offs. So that's some of the idea of how heavily weighted some of the gains have been to a select number of stocks. The idea of bonds and stocks moving together, I think, is relevant because so many people have been saying, well, actually, including we started the show with Margit Patel, saying actually stocks can hang in there and continue doing well regardless of what bonds are doing because they can go even lower in price, higher in yields. And that's some of what we were hearing from other people, too.
I mean, I'm looking at the Dow, back to the Ancampora call in 1995. Folks, you can do this on an HP 12C while Bramo's going on. Ready? 6.97% before any dividend reinvestment. Back to the Ancampora low of 4,005. I went to 5,000.
It's always fun when I'm talking and I see you looking at a
calculator,
just absolutely ignoring, and I'm just like, okay.
I can bring a conversation at a bar to
I know.
complete. That was great. 6.97% on the Dow. Back to Ralph's great call in 1995. And our team just fell asleep.
Sorry, I'm looking at my calculator.
Speaking of HP 12C, he's going to bring us Monroe trader Bill Gross, 2 p.m. Stay with us.